To go until the start of cash equity trading. I'm Tom McKenzie.
If we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening.
Jerome Powell reiterates fighting inflation remains the Fed's top priority less than 2 weeks after the second biggest bank failure in US history. But conflicting messages about deposit insurance from Powell and Treasury Secretary Janet Yellen baffle the markets, with the S&P 500 whipsawing before ending the day sharply lower, driving European futures into the red. Plus, with inflation concerns continuing to swirl, policy decisions are on tap from the SNB, Norges Bank and the Bank of England. Rate hikes are expected across the board. European markets then assessing that decision from the Federal Reserve to go ahead with 25 basis points. And yes, ultimately, Jay Powell and the FOMC did pick a side between inflation and financial stability. Financial stability taking a sidestep to one extent, to some extent at least, as the inflation fight remains a key priority. But this was also a Fed, and this was also a Fed leader in Jay Powell that opened the door potentially to a pause in rate hikes. There's a lot of uncertainty, of course, with FOMC and for Jay Powell as they weigh up those inflation pressures with the longer-term impact of that crisis around the banking sector and what that is doing to these financial conditions. We look at the open. The Spanish IBEX currently down 0.6%. It was a positive session in Asia, some relief coming through the likes of Tencent, earnings there driving the index in Hong Kong higher. But here, the focus is on the inflation question and that additional 25 basis points coming through from the Fed as we look ahead to the BOE. The FTSE 100 currently down 0.4%, a drop of 29 points. The Spanish IBEX off by 0.5%. Let's look cross-asset then, given the sell-off that we saw yesterday on Wall Street. Again, the whipsawing, and it was certainly the Janet Yellen, Jay Powell split screen that caused concern and angst for those traders, particularly as Janet Yellen suggested that there was no discussion around guaranteeing deposits, putting her somewhat at odds with the signaling from Jay Powell. The futures in the US now pointed to gains of 0.7%, so a little bit more relief coming through as US investors weigh up those mixed messages. The 2-year, 392, you saw yields coming off about 23 basis points at the front end. That steepening of the yield curve continues, and you're seeing just a close to 2 basis point move today. The pound in focus for us as we lead up to the Bank of England, 123, strength coming through for sterling, up 0.4%. The Bank of England expected to hike given the inflation pressures coming through, and that's is the shape of things across these assets. Let's get back to what happened with the Fed then. Hiking by 25 basis points and Jerome Powell signaling more tightening may be in store.
If we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is.
However, in a Senate hearing at the same time, as I mentioned, Treasury Secretary Janet Yellen said that regulators are not looking to provide, quote, blanket deposit insurance for U.S. savers.
We have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits.
For more on this, let's bring in Bloomberg's markets reporter, Valerie Teitel. What were the main takeaways then? It was a confusing day for these markets.
Well, Powell really sent us a dovish hike. The two-year yield's now rallied around 25 basis points since the decision was released. And the markets are really seeing this could be the last hike of the cycle. It could be the turning point of the cycle. He was especially candid about the risks ahead, about the uncertainty and the unknown ahead. This is the key change in the opening statement, where he specifically talked about the recent developments in the banking industry are likely to result in tighter credit conditions, which will weigh on inflation, but the extent of these effects are uncertain. He then went on to speak about the banking turmoil, saying that a pause was considered and that a significant number of Fed members see tighter credit conditions ahead. It could be modest, it could be significant, we just don't know. He did say some positive things about the deposit outflow, that it has stabilized this past week.
A pause was considered. That was really crucial, wasn't it, in terms of the language and the commentary we heard from Jay Powell. Swap traders pricing in, they're kind of 50-50 on whether or not we get another hike. What is the bar? What would need to be seen by this FOMC to go further and add additional tightening?
Yeah, to me, they need to see complete confidence that the banking system problems are behind us, and any tightening of credit conditions that come from it don't lead to below trend growth. They still need to have confidence that the economy is running above trend in order to warrant another hike. But, you know, the shift, I think, in markets is going to shift rapidly from inflation to the more surveys on lending standards that we get. How many banks were affected by this turmoil? How strongly will they react? Will they actually tighten lending conditions, lending standards as their reaction? And how long will this go on? We have 6 weeks until the next Fed meeting. You know, the question is, will it show up in the data enough to warrant the Fed to pause at that May meeting?
Yeah, and again, Torsten Schlock of Apollo Global saying that the banking crisis has led to an equivalent 1.5% tightening in terms of rates. We'll see, as you say, around the loan conditions, whether that comes to pass. Valerie Teitel, our markets reporter, assessing then that decision and the commentary from the Fed and Jay Powell. Let's bring in Bloomberg anchor Francine Lacqua, who is back in Zurich covering another critical central bank. And Francine, the team at Bloomberg Economics, they expect, what, a 50 basis point hike, I think, from the SNB. But the focus, of course, will also be on the questions around financial stability, given UBS and Credit Suisse. Francine.
Yeah, when's the last time, actually, we sent a full reporter to cover this conference? In fact, the S&B usually does a presser at their headquarters. Today, they're moving it to a hotel simply because there's so much interest in this. Now, look, they have the same dilemma, Tom, as the Fed had yesterday. There's a banking crisis. They need to stabilize it. It probably doesn't warrant a hike, but at the same time, they see inflation rising. The trend of inflation here in Switzerland, very different to any other country, frankly. They're at 3.4%, so there's nothing to freak out about, but the S&B president had said he needs to keep a handle on it. So in the presser, I'm expecting a lot of questions on the banking system, on outflows, on whether they can stabilize this. And very importantly, FINMA, the regulator, today, after 5 days where this government-led togetherness or put togetherness of Credit Suisse and UBS actually wiped out $17 billion of AT1s, FINMA finally put a statement in saying why they made that decision. So I'm also expecting the timing of this is not casual. I'm also expecting the S&B to field a lot of questions on that. So this is banking crisis versus higher inflation. What will they do?
Yeah, a day when the SNB and its decision and anything we hear, of course, from Jonas Jordan just jumps to the top of the agenda in terms of importance. Francine Lacqua on the ground for us, of course, who will be covering that story throughout the day. Thank you. Let's check in on these European markets again. Just for the context, you had that sell-off in the US as investors weighed up that decision. Valerie Teitel describing it as a dovish hike from the Federal Reserve, and that aligns with the views of many others, but it was a comments certainly from the Treasury Secretary around the fact that they were not discussing or considering a blanket guarantee for deposits in the US that led to the sell-off, arguably towards the end of the day in the US. You had a more positive session in Asia, but currently across the benchmark here in Europe, losses of 0.4%. The DAX is flat, and the FTSE 100, as we lead up to the Bank of England's decision, is down by 0.3%. Let's get more analysis now and bring in TS Lombard's senior global macro strategist, Skylar Montgomery-Conning. Skylar, good morning. Thank you for joining us. Your views on the Fed decision, is there a risk of a policy misstep by this Federal Reserve, given the financial condition tightening, given the banking crisis, as they raise rates?
Yeah, I mean, that's always a risk, right? But I think what you've seen is this is kind of normal course for a tightening cycle, right? We've gotten used to this world of perma low rates, QE, rates at the very, very, very zero lower bound. And now that we're getting this tightening, you're getting these kind of bubbling up of market fragilities being exposed. And I think that's just kind of normal course for the tightening cycle. We're just not used to it. And so we're having all of these stumbling blocks along the way. And there's a very real possibility that there's a mistake made, but I don't think this is the mistake right now in terms of the ECB hike last week was well digested. The Fed hike has also been well digested. And, the biggest thing that policymakers have learned in 2020, as well as post-GFC, is that if you react quickly to crises, if you put in action quite aggressively to fight these risks, then the contagion doesn't spread as much and it's able to stem it. And I think that what you're seeing is, yes, we've kind of had this rolling crisis in terms of one fragility is exposed and then another within the banking sector, but they've all been quite well contained and continue to be well contained, and they put measures in place to kind of stem the tide.
Are the bond markets right to be pricing in a cut, or at least a number of cuts by the end of the year from the Fed?
Well, yeah, so this is interesting, actually, because we've had a call for very aggressive cuts to the end of 2023 for quite some time in terms of we've had that call since the end of last year. And we see the policy rate being cut to 275 at the end of this year. And that was largely because, as I said, this is normal for a tightening cycle. The economy gets squeezed. It happens quite rapidly. And when you do get recessions, it happens very, very quickly. So generally, between the trough in unemployment and the peak, it takes around 12 months on average. That means recessions are nonlinear, and the response from the Fed during recessions tends to be quite aggressive. You get at the very least 200 basis points. I think the other really important point to make is, regardless of whether we get a recession, even though I believe that will happen, if they keep Fed funds where it is and inflation falls as they expect and the market expects, then real Fed funds get artificially tight. So you'd expect even at that point, with the economy already showing signs of stress, inflation falling, even if we weren't in a recession, you'd probably expect cuts.
That's a big call, 275. Just to be clear, 275 by the end of this year is where you think rates will be.
Yes.
What does that do to your view on the economy, the US economy? You think a recession is coming. How prolonged, how deep is that likely to be in your view?
So I think it's a mild recession. It's 0.6 percentage points off aggregate GDP. Unemployment rate rises to 5.5%. And it's a mild recession partly because, we've seen it coming. It's, widely the most predicted recession in history, I think, and that's partly because it's been caused by the Fed funds tightening, and it's the squeeze in the economy you'd expect. So yeah, a relatively mild recession. That doesn't mean that it doesn't have impacts for asset markets in terms of, for example, I'd expect fixed income to rally quite strongly on Fed cuts alone, but also on the recession view. And you're starting to see that already, I think. But yeah, not particularly deep. However, saying that, the fact that we've had these banking crises and we've had these issues within the banking sector, you were already seeing lending standards tightening. And if anything, this accelerates that. And so it raises the risk of a hard landing, and it raises the risk that we do get this deeper recession.
Okay, yeah, as you say, money continuing to move into the front end, 391 on the 2-year, just to move lower by 2 basis points. But given the 23 basis point move lower in yields at the front end yesterday, that continues in terms of the momentum around the front end. Skylar Montgomery-Conning, TS Lombard, Senior Global Macro Strategist, stays with us. We're going to get more of our calls just in the next couple of minutes. Coming up, dollar bears roar with delight off the back of the Fed's latest hike. Yes, more pressure on the greenback. Is it suffering from lack of confidence in the central bank's narrative? And what does it mean for the broader FX space? That is next. This is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says, Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021, and now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Welcome back to the Open. Happy Thursday. We are 15 minutes into your European trading day. Losses across the European benchmark of a little over 0.4%, but it's a brighter picture as you look to the futures in the US. Gains on the S&P E-minis of 0.7%, and a solid and decent session over in Asia, partly as a result of softer dollar. The Bloomberg Dollar Spot Index fell as traders amped up bets for more Federal Reserve rate cuts. They've, of course, hiked by 25 basis points, knocking confidence in the greenback. For more, we're joined by Bloomberg M Live team, from the Bloomberg M Live team, by Eddie van der Volt, who's looking at all of this for us, and maybe we'll get a question in on crypto as well. But let's start with the greenback then. 6 straight days now, losses for the greenback. Has it lost its mojo? Has the safe haven status crumbled?
Yeah, you know what? I think Powell did a lot to rattle confidence in the dollar yesterday, because not only was this a very dovish hike, right? He also expressed a lot of uncertainty about the economy, and that rattled investors. But interestingly, normally when investors have been rattled in the last few years, really, they went straight to the dollar. Not so yesterday, because there is this difference in messaging from the ECB, who's still sounding very hawkish. ECB has a very different mandate, of course, not so much about financial stability, but they sound much more hawkish. So you see the euro rally, you see other currencies rally, and the dollar not getting the haven bid. That haven money is looking for a new home, and they haven't really found one yet.
Is this a temporary phenomenon in your view, or does this theme of dollar weakness, losing that haven bid, does that continue as we look to the hawkishness coming through from the ECB?
Look, I think the ECB will probably start reassessing its hawkish messaging over the next few days. I think they still sound quite hawkish in the messaging that they've sent up until now, but given just how bearish, not even, how bearish Powell sounded, I think the ECB will start questioning themselves a little bit, but they are in a different place. So I think if they start reassessing, then I think we see the dollar finding that footing and finding that haven trade once again.
And just briefly, Bitcoin up above 27,000, right? It's just kind of gradually crept up from 22,000 to 27,000 now. Is there a safe haven bid there? Is it a bet on rate cuts? What's going on?
It's a plague on all of your houses bet. It's a we don't trust the financial system. We think it's all rigged. We see banks fail. We see banks being bailed out. We don't like it. I don't like this. You know, I don't like the financial system. I'm going to Bitcoin. But Bitcoin has its own fundamentals at the moment too. But there's dissatisfaction with the financial system. That's how Bitcoin was born, and that's how it's getting its bid right now.
Okay, Bitcoin currently trading at 27,680. The Bloomberg Dollar Index again lower by 0.4%. Always excellent. Eddie van der Volt from our Air Live team. Thank you very much indeed. Let's bring back in T.S. Lombard, Senior Global Macro Strategist, Skylar Montgomery-Koning, who is still with us for some analysis. And Skylar, let's get to, before we get to your to positioning and how you allocate in these markets, I just want to get your view on given what we're seeing for these central banks, the tightening and the conditions, the financial conditions as a result of the financial stability issues in the banking sector. Is there another sector, is there another shoe to drop? Is it real estate? Is it the credit markets? Is there another area of concern that you're zeroed in on?
Well, I mean, I think this is the problem, right, in terms of no one really saw the pensions crisis coming. You know, there were investigations into SVB, but, you know, I think the broader market wasn't really concerned about that. So I think, you know, these kind of unknown issues or these unknown vulnerabilities, they're the worst kind because they become unexpected. I will say in terms of something we've been flagging is exposure to commercial real estate. So quite a lot of banks have commercial real estate on their books. They've been written down in value. The housing market and real estate generally has just pretty much been frozen. It's just been the stalemate because there haven't been forced sellers yet. And, you know, the values will at some point have to be written down. And so that's somewhat of a concern, but I think that's more of a slow burning concern. That's a further in the future issue than kind of a light matchbox issue.
Okay, Skylar, before we let you go, how have you changed your allocations?
Well, this is the thing. We've pretty much kept our allocations the same from 2 weeks ago. We did our asset allocation last week. I think if anything, the one thing that has changed is this rising probability of a hard landing. You know, as I said, credit conditions, they were already tightening. I think this just accelerates that. Credit conditions feed into the economy quite a lot. And, you know, I think if anything, that means that you get lower growth or a deeper recession. And so in a hard landing scenario, you would expect government bonds to rally quite aggressively. You'd expect risk assets. You know, right now they're kind of looking through the GDP numbers to look at the Fed and the pivot and thinking about that being a positive. But in a hard landing scenario, growth is bad enough that equities do really suffer. So you'd reduce your allocation to equities, and then we still like IG credit. So credit has actually been quite great in the last 2 weeks in terms of if you're a spread investor, yes, spreads have widened, but the total return in government bonds has more than compensated you. So it's kind of that between a soft and a hard landing. That's where you'd want to be if that's your view. And for us, that's where we're allocated.
Okay, still like IG credit, cutting exposure to equities. Skylar Montgomery-Koning, always excellent. Thank you for joining us. T.S. Lombard, Senior Global Macro Strategist. Now, coming up, to be or not to be a security. That's the debate between Coinbase and the SEC. Hat tip to our producer, Alina, for that one. I may not have done it justice. We've got more on that coming up next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
The banking system is pretty sound, and we're talking about a few banks. We heard it from the chairman, Powell, today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks.
Citigroup CEO Jane Fraser speaking there on the state of the banking sector. Talking of which, let's bring up your pre-market movers. There's a focus, of course, on what's happening with Coinbase, and we're going to get into that story with Alex Webb shortly, but also First Republic, given what we heard from the Treasury Secretary. And you can see pre-market, First Republic actually gaining 3.5%. And you also have in there Chewy, the pet supply company, suggesting that sales are going to slow down 0.8% pre-market. But let's get into that Coinbase story then. The US SEC, look at it, down 10% pre-market. The US SEC has warned that Coinbase, the country's biggest crypto exchange, of its plans to sue. It is the latest development in the dispute over whether crypto products are securities and hence if they have a proper vetting process. Let's bring in Bloomberg Quick Takes Alex Webb. What do we know at this stage, Alex?
So the SEC has brought an enforcement notice against Coinbase, which is the largest crypto exchange. They've been in discussions for much of the past 9 months or so. Coinbase obviously perhaps, asserts its innocence of this. The key thing is they're saying these aren't securities. The government is saying, or the SEC is saying that they are.
And why are the SEC being so aggressive at this point?
Well, I mean, a lot of it is the fallout from the FTX scandal, where you saw lots of investors, and particularly retail investors, wiped out. And they've been accused of not necessarily protecting those retail investors as well as they could have done. That seems to have accelerated a lot of the things they're doing. And it's not just Coinbase, it's in the firing line. We've seen Kraken, one of their competitors, and others besides.
Yeah, and Coinbase, as you touched on, saying that they're going to fight this if it goes to court. They're going to fight this. They believe, and their legal team were telling Bloomberg, they believe they have a very, very strong case indeed. But certainly, as you say, an indication that the SEC is taking this more seriously, as they've been accused by some of being on the sidelines.
The thing that's really interesting is it parallels a lot of the things we have with social media over the past decade, where social media companies would say, we're a platform, we're not a publisher, right? So we are not responsible necessarily for all the content that goes on our platforms because we are just literally a way of connecting people. It's a similar sort of argument we're now seeing with these exchanges, that they are just a medium to connect people with these things that they say are absolutely not securities. Therefore, similarly, we are not a publisher.
Okay, that's a really interesting comparison. Alex Webb, thank you for the analysis. We'll get more details on, of course, this SEC potential legal action against Coinbase. It's not doing much in terms of dampening the enthusiasm, at least for now, around Bitcoin. That currently trading at around 27,000. Coming up, the BOE looks set to cement the current tightening cycle with its latest rate decision today. We're going to get more on that next. Your markets here in Europe currently off by 0.4%. Stay with us. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Jerome Powell reiterates fighting inflation remains the Fed's top priority, less than 2 weeks after the second biggest bank failure in US history. But conflicting messages about deposit insurance from Powell and Treasury Secretary Janet Yellen baffle the markets, with the S&P 500 whipsawing before ending the day sharply lower. European equities turn negative. Plus, with inflation concerns continuing to swirl, policy decisions are on tap from the SNB. In fact, that decision has come through. We await the BOE. Here's the line from the Swiss National Bank, then raising its policy rate by 50 basis points, in line with the forecast from the team at Bloomberg Economics, that rate being raised to 1.5%, in line with the estimates. So the SNB raising by 50 basis points. The Swissy is gaining versus the US dollar by about 0.4% on the back of that move. We know that inflation is a concern in Switzerland, even if it is not as high as it is in many other parts of Europe. We know, of course, that there is a major gap, a huge gap in terms of the policy rates between the Swiss National Bank and other major central banks. But of course, we also expect to hear from the central bank governor, Thomas Jordan, about financial stability, given his role in engineering the UBS takeover of Credit Suisse. But that is the headline from the SNB. They have raised by 50 basis points. The SNB can't exclude more rate hikes in the foreseeable future. The SNB saying it is prepared to intervene in currency markets if needed. The SNB seeing 2023 GDP at about 1%. And the SNB sees 2023 inflation at 2.6% before moving down to 2% in 2024. The SNB also saying that Credit Suisse measures have put a halt to the crisis. SNB, the Swiss National Bank, saying that Credit Suisse measures have put a halt to the crisis. Francine Lacroix, of course, is on the ground in Zurich and will bring us more on this story throughout the morning. Currently, you're seeing the Swissy gaining 0.6% versus the US dollar. So a decent pop there for the Swiss franc, likely tied not just to the increase of rates, but also the guidance that the SNB cannot exclude more rate hikes in the foreseeable future, and saying that a floor essentially has been put around the crisis involved in Credit Suisse. Okay, this story will get more details live from Zurich in the coming hours. Let's now get the Bloomberg Business Flash with Madison Mills in Dubai. Madison.
Thanks, Tom. Neither billionaire Jim Ratcliffe nor the Qatari consortium interested in buying Manchester United have reportedly submitted improved bids for the British football club. According to Sky News, both bidders were granted extensions to last night's deadline to increase those initial offers. The groups are competing to acquire the club from the American Glazer family. China Evergrande Group has announced its long-awaited multi-billion-dollar reconstructuring plan. The world's most indebted developer says it will give creditors the option to swap their debt into new bonds and equity-linked notes. The company says returning to normal operations will need financing of at least $36 billion. And World Bank President David Malpass says a global recession still not off the table. The lender is reviewing its global growth forecast following China's lifting of its COVID lockdown. Malpass told Bloomberg the lack of investment in developing economies is particular cause for concern. Take a listen.
In the latest, what we've seen is advanced economy growth expectations had gone up some late last year. That's the U.S. and China in particular, as China lifted the embargo, the lockdown. And so as we're looking at it now, the growth is slow but positive in advanced economies, but in developing countries, not much investment taking place. That, I think, is the big challenge.
And Renault is preparing to list its electric vehicle business, Ampere. Bloomberg's learned the French car maker has invited investment banks to pitch for a role on the planned IPO. Renault is considering listing the firm on the Euronext Paris bourse as soon as the fourth quarter and aiming for a valuation of nearly $11 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Okay, Madison Mills, thank you. Now, yesterday it was the Fed. This morning it was the Swiss Central Bank coming out with their rate hike of 50 basis points. And later today is the turn of the Bank of England. The BOE's latest rate decision is due to be published at noon here in London. And it comes a day after markets were surprised by hotter than expected UK inflation data. Let's bring in Bloomberg's UK correspondent Lizzie Burden, who's outside the Bank of England. What are we expecting from the BOE today, Lizzie?
Well, Tom, I'd say that upside inflation surprise yesterday uncomplicates matters for the Bank of England. There had been some economists, not naming names, who'd said that the recent banking stress actually meant that financial conditions have tightened so much that the legwork's been done for the Bank of England and actually it's time for a hold. But this print really makes it look as if a 25 basis point hike is coming today. That's what markets expect. It's pretty much nailed on. What will be interesting, though, is the vote split, because there are expectations that John Cunliffe will join Silvana Tenreiro and Swati Dhingra in dissenting for a hold. They're worried that the previous jumbo hikes have yet to fully take effect because of the lag in monetary transmission. But given his responsibility for financial stability, perhaps he'll go with the majority and vote for 25 basis points to show his confidence in the financial system. Also a question mark over Catherine Mann, the committee's big hike. Hawk. Will she go for a 50 basis point hike given yesterday's print? That vote split, though, should be an indicator as to how many and whether the bank will continue to increase interest rates.
I think merging Hawk and hike with Catherine Mann is appropriate, Lizzie. Prime Minister Rishi Sunak, he, of course, has put a focus on the importance of getting inflation down, halving it by the end of the year. To what extent does the print that we saw yesterday derail that ambition?
Well, it wasn't the news that Rishi Sunak wanted to get at 7 a.m. yesterday, but by the end of the day, he seemed to emerge pretty much unscathed. On inflation, economists still reckon that it will come down by the end of the year, even if it looks a bit stickier than expected now. He also had some good news on the Northern Ireland deal, the Windsor framework. The vote yesterday was in the government's favour, 515 votes to 29, even though Liz Truss and Boris Johnson joined the rebels. And Boris Johnson was giving his televised testimony in Parliament yesterday on Partygate, the gatherings at Downing Street during the COVID lockdowns. It was a heated, long testimony. He sometimes lost his temper. But that seems to reflect well on Rishi Sunak. It reduces, it seems, the chances of a Johnson comeback, even if it casts a long shadow over the Conservative Party.
Okay, Lizzie Burden outside the Bank of England, thank you. Let's bring in now HSBC senior UK economist Liz Martins. Liz, great to have you on the show this morning. Is it going to be one and done then from the BOE?
Yeah, we think so. And actually, as Lizzie was saying, this is actually quite a close run, a finely balanced call in the first place. I mean, following the inflation number yesterday, we probably do think it tilts the balance in favour of a hike, but I don't think it's a done deal. Of all the central banks around the world agonising over what to do about financial turmoil versus inflation concerns, I think the BOE is the most likely to be dovish, to hold rates, to have a few votes for people wanting to hold rates. You know, Andrew Bailey said even before the financial turmoil began, don't assume we're going to hike rates again. So I think, yes, the inflation print has swung it and we will get a hike today. But as you say, I think we're at the end. I think that's it then.
Okay, interesting. And you touched on the banking terminal, the financial terminal, and we've had some estimates in terms of the tightness in terms of financial conditions in the US. Do you have a view? Do you have enough data at hand to make an assessment as to what extent financial conditions have been or will be tightened as a result of that fallout here in the UK?
I think it's really hard to say because it depends how long that turmoil lasts, right? And obviously, you know, a little bit more risk aversion towards banks, and in turn, banks take that risk aversion and reduce lending, or a bit more cautious about lending. And of course, that, you know, in theory, does the central bank's work for them. But of course, if you have a big rebound in markets, and we have seen markets stabilize, that effect might be quite limited. And at the same time, you've seen swap rates come down, yields come down, you know, which is the opposite, which is loosening. So I think, you know, we have to wait and see what things like the credit conditions survey tell us, and bank lending more generally, about how much work that market turmoil has done, and how much those inflation pressures are still in the system and need to be dealt with through monetary policy.
Yeah, and to your point, gilt yields coming down again at the front end, 7 basis points on the 2-year at 341, 342. Liz, take us through. It's a murky picture. I get it. There's a lot of headwinds, there's a lot of uncertainty. But look through to 2024. Where do you see rates?
So we think there'll be one more hike, as I say, today, and then we think we're done. And we've kind of got rates on hold from there at 425. Now, the market clearly thinks the next move is down, and it may well be right. If inflation drops like a stone, unemployment picks up, maybe, you know, have a mild recession, it's more than possible that the BOE does tackle that by cutting interest rates. However, on our forecasts, inflation isn't going back to target in the next 2 years. And actually, we've got a very tight labour market, which means that pressures from that, add in the supply side damage from the pandemic, from Brexit, from other factors, mean that actually maybe inflation is structurally higher. So then the question for the BOE becomes, you know, if inflation stabilizes at 3%, do we continue to hike rates and damage the economy in the process to try and get it down to 2%? Or do we say, well, we can tolerate inflation at 3%? Now, that's a question for them, and I think it's an open question. It's something, you know, economists have been talking about really since this inflation upturn began, whether central banks might tolerate a higher level of inflation. But we think the bar for them cutting is probably quite high because, you know, it's one thing to stop hiking, but actually cutting back, I think, you know, things would have to get considerably worse from here.
Okay, structurally higher inflation, structurally higher rates, maybe at around 3%, and then the questions as to how they get it back down to 2% if indeed they stick to that decision, that target, that forecast. How do you map all of that onto the health of the UK economy that has shown, at least in some areas, some surprising resilience? Do you agree, do you align with the OBR forecast that we avoid a technical recession?
We're forecasting still a small technical recession, but given everything this economy has been through, I think that's a pretty good outcome. You think about this huge consumer income squeeze, and we've been waiting and waiting to see the impact of that on demand. And yet, you know, actually, as we've come into 2023, the survey have started to pick up. You know, you've seen the business confidence pick up, consumer confidence pick up. Now, we will see what the impact of financial turmoil is, and I think it will have an impact. But generally speaking, I think this economy has been incredibly resilient. However, I think, you know, we spent 2022 worrying about, you know, energy and household energy bills. I think as we've come into 2023, we're worrying about food prices, we're worrying about rent prices, and we're worrying about the impact of those rate rises
on our mortgages, but also, the cost for businesses. And it also, of course, is a constraint on government spending as well. So I think we've gone from worrying about inflation itself to worrying about the impact of the medicine for inflation, the rate rises.
And those salad shortages in our supermarkets. Liz Martin, always spot on with the analysis, senior UK economist at HSBC, on the call that the BOE will go one more today, 25 basis points, and then done. Hold for a while in this inflationary environment. Thank you. Stick around, because later today we're going to have, of course, coverage of the Bank of England's rate decision starting at 12 p.m. UK time on Bloomberg TV and TV Go. Let's check in on these markets before we get to break. You're seeing losses across European equities of 0.3%. So pairing some of the heavier declines at the start of the session. The futures are still looking positive in the US, gains of 0.7% after the losses yesterday on the S&P E-minis. It was a decent session over in Asia. The benchmark there gaining 1.3%. Softer dollar was at play. Also some strength in terms of the earnings coming through from Tencent. Here's a look then at the individual indexes. The FTSE 100 as we lead up to that BOE decision, currently down 0.5%. The DAX off just by 13 points, not much. And across the benchmark again, down 0.3%. Gilts are bid again today, as we mentioned, yields coming off. In the US, though, yields just ticking up by 2 basis points at the front end, 3.95 after the move lower, 23 basis points lower on yields at the front end too yesterday. Coming up, the Swiss National Bank hikes by 50 basis points. We're going to have more on that, and of course, the Credit Suisse fallout. That is next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful, because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. Let's get out to Switzerland now, where the central bank has just raised its key policy rate by 50 basis points. The hike was in line with expectations and comes as Switzerland's banking sector, of course, faces scrutiny following the Credit Suisse turmoil. For more, let's bring in Bloomberg's Swiss bureau chief, Claudia Medler, in Zurich. Claudia, walk us through this rate decision then, such a central time for this central bank.
Yeah, very central time, very important, but the message, I guess, here is there's nothing to see. So basically, as you said, the central bank raised rates as expected by 50 basis points.
And that was expected before the weekend. And then, you know, in the last couple of days, maybe there were some people who were saying, oh, maybe it will raise less, maybe it won't raise at all. But, you know, it kind of showed there's nothing to see here. If they hadn't raised at all, or if maybe they'd done less, there may have been speculation in the market that maybe the central bank knows more than we do, and then there would have been new nervousness. So clearly rates went up as expected. That also shows that the central bank put its focus again on inflation. Inflation here is not as high as it is everywhere else. It's about 3.4% in February, though that was a bit of a surprise. Prices went up more than expected because of things like gasoline and rents and so on. And for the central bank, it's really important to keep this inflation rate where it is, or bring it down as well. So this is also a reason why those rates went up. By the way, in the statement today, it did make comments around Credit Suisse, and they did say that the measures that they put in place, they helped halt and avert the crisis.
Yeah, indeed, and of course that was a consequential, important line coming through from the SNB. They also touched on, or at least, can you give us more light on what's happening with the controversy around the additional Tier 1 bonds?
Well, yeah, there's been lots of controversy over the last couple of days, right? We've seen bondholders go to law firms and trying to figure out what to do. Like, who can they sue? Can they sue the Swiss government? Can they sue FINMA? They're trying to figure out, you know, they just feel very, very unfairly treated. Now, FINMA this morning came out again and basically kind of laid out its reasoning and justified its decision. They said that they looked at the bond prospectus and they looked at the federal decree, and based on those two things, that it was okay for them, that it was, you know, in the case of a viability event, that those bonds would have been written down, and that's exactly what happened. So they feel that this is how it should have been done, even if bondholders and the bond market doesn't agree necessarily.
Okay, Claudia Medler in Zurich, thank you very much indeed for the analysis and the take on that decision by the SNB and the language, particularly around potential hikes coming in the future from the Swiss National Bank. And of course, their views, the turmoil emanating from Credit Suisse has now been put to one side. Don't miss Francine Lacquoire's interview. This is going to be really fascinating with the Swiss National Bank President Thomas Jordan. That is later this morning. Of course, there will be lots of questions about financial stability and what led up to the takeover by UBS of Credit Suisse. That conversation, 11 a.m. UK time, 11 a.m. UK time, 7 a.m. in New York. Coming up, it is 1-1 so far. The sale of Manchester United enters extra time after an extension of the bids deadline, but who will score the winning goal? Well done, producers. We get the latest next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, So that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Welcome back to the Open. We are 53 minutes into the European trading day. European stocks pairing some of the heavier losses in the session, currently down 0.3%. You're seeing a very slim amount of optimism coming through for the DAX and the CAC Garant. Here in the UK, the FTSE 100 off by close to 0.5%. The Bank of England decision, of course, in focus for us today after that red-hot inflation print of yesterday. Futures in the US, though, pointing to gains after the losses on Wall Street yesterday. S&P E-minis up 0.7%. Let's take a look now at some of the other things that we're going to be watching out for today. I flagged this, of course, we've been discussing it, the preview of the Bank of England, 12 p.m. UK time. We're going to have the latest in terms of the rate decision from the BOE, followed at 12:30 p.m. by the US initial jobless claims. And at 1 p.m., Treasury Secretary Janet Yellen will testify before a House subcommittee on the federal budget request and the economic outlook. Will be interesting to see if she walks back her comments around no guarantees, no blanket guarantees for deposits in the US. Then at 3 p.m., we're going to have the March Euro area consumer confidence reading. Also today, EU leaders are gathering in Brussels for a two-day summit. And later, President Biden heads to Canada, where he's due to address the Canadian Parliament. Now to football. And neither billionaire Jim Ratcliffe nor the Qatari consortium interested in buying Manchester United have reportedly submitted improved bids for the British Football Club. According to Sky News, both bidders have been granted extensions to last night's deadline to increase their offers. Let's get some insight then on this huge sporting contest with Bloomberg UK business reporter and expert on all things football, David Hellier, and the business of football. David, where do things stand then in terms of this bid, this fight for Man U?
Well, we're coming close to the end game, but of course, there's all sorts of processes that still have to be completed, like due diligence, which can take a few weeks. Yesterday was a significant milestone. There was a deadline for bids. As with these processes, the Chelsea process, which was also handled by Rain, the US investment bank, there's a certain flexibility about these deadlines. But we basically, by yesterday, we really only had two publicly named bidders, as you said, the Qatari consortium and Jim Ratcliffe. And that's far fewer than when we had the same situation with Chelsea.
Why is it just two public bidders so far? How many did Chelsea have by comparison? And why are there so few for Man U?
Yeah, I mean, Chelsea had about 20 at the beginning. It was whittled down to 4.
Right.
And then one pulled out, actually. But it's a big difference. I think, I mean, two things. One, everybody knew that Chelsea had to sell. There's a very different situation here. The Glazers have made it quite clear that they don't have to sell, they could carry on, and so they're really demanding a big price. And then the price is the second thing. There's a third thing as well, which is so the price is at least double Chelsea, according to analysts. So that rules out a lot of people, a lot of consortia.
Okay, David Hellier, thank you very much indeed. And of course, you can continue to keep across the reporting from David Hellier and their team on this story as it continues to unfold. Thank you very much indeed for the latest on the story and the bids for Man U. That is it for the European market open. Surveillance early edition is up next as we check in on these markets. Just down 0.2% across European stocks after that hike by 25 basis points. A dovish hike is the way it's been characterized by many from J. Powell. Futures in the US up 0.7. This is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Banking system is sound and resilient with strong capital and liquidity. My only interest is that we identify what went wrong here. How did this happen?
I think the key thing is they may be underestimating, which is exactly why, if I were in his shoes, I would have favored a pause.
He said we don't know how much credit tightening is going to come from what's gone on in the last couple of weeks, but we do know that inflation is a real problem. I think what he said was, frankly, jolly sensible.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It is 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Fed makes it clear, despite the banking crisis, fighting inflation is still its main concern. More central bank moves on interest rates. The Swiss National Bank just came out, and the Bank of England decision is later today. And a game changer for bank runs. Citibank CEO Jane Fraser warns that mobile money marks a sea change for both bankers and regulators. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York, Anna Edwards and Matt Miller are off today. So as the investors, of course, and traders wake up here, at least in Europe, to that 25 basis points, a dovish hike is the way that many have interpreted it from Jay Powell. We, of course, weigh up the Swiss National Bank and then in seconds, the Norges Bank as well. There's the decision that's coming through at the bottom of the screen. The Norwegian Central Bank raising its benchmark interest rate to 3% in line with estimates, Kriti. The Bank of England expected coming through with 25 basis points as well. So for the moment, Kriti, it seems these central banks are putting concerns about financial stability to one side and keeping that focus on inflation.
Yeah, a crucial 24 hours in central banking around the world. We're going to dive into it in just a moment, but a quick check on the markets first, Tom, because we are seeing, to your point, that dovish hike, an oxymoron if I've ever heard one, but take a look at futures. Seems to be kind of rallying in line with that. The idea here simply being that perhaps equities were expecting this to some extent and were priced, therefore, to perfection, dare I say it, higher by 0.7% this morning. But remember, the reaction on the back of that as well was a higher equity market. So you really have to talk about this in the context of the carnage we saw last year, how much of the rate hikes are already priced in. I think the real action is in the bond market, though, because here's what's interesting. Here's the highlight for me. Even as we see a hike of 25 basis points, yields went down. The currency went down. And that's something we've really only seen with the Bank of England and arguably the Swiss National Bank as well. Nevertheless, it happened here in the States as well. A two-year yield of 3.96, really penetrating below that 4% crucial level. Now, this is something to keep in mind for the currency market as well, because as yields drop as well, the dollar will follow. You are seeing weakness in the greenback to the tune of about 0.4%, Tom. Not necessarily creating that bid into NYMEX crude as you would expect, weakness in the dollar to help fuel commodities. Yet today, only really trading with a 70 handle, still lower by about the same margin, down about 0.4%.
Okay, Kriti, thank you. Let's bring you back to the central bank action, or at least zero in on what is happening in Norway then. And is the Fed now suddenly becoming the dove in the room of these central banks? Because Norway's coming through with the hike that was expected. But what you're seeing then is the upside for the Norwegian currency on the back of this versus the US dollar, gaining 0.9%, raising then that interest rate to 3%. Again, in line with estimates. And the Norwegian Bank saying that the rate will be further raised in May. So the guidance on further rate hikes from the Central Bank of Norway coming through for May, and that is propelling a stronger Norwegian kroner. And again, it follows the rate hike of 50 basis points from the Swiss National Bank. Again, they said in their commentary they're putting to one side the financial stability risks. Those have been contained, was the line from the SNB, and they also flagged the potential for further rate hikes coming through from the Swiss National Bank as well. We look ahead again to the BOE later today. Talking of the Bank of England, you're checking in on the pound, 123 for sterling. Yes, dollar weakness is part of the play here, but also the expectation that on the back of red-hot inflation out of the UK yesterday, you're going to get at least 25 basis points from the BOE, gaining then sterling 0.4%. Across the benchmark on the equities picture, you're seeing losses of 0.4% here in Europe, despite the fact it was a solid session over in Asia. There's the Swissy gaining 0.4% against versus the US dollar, and 344 after yields came in at the front end in the US by 23 basis points. Was what I'm talking about is the 2-year US. Here's the gilt in terms of UK, 344 on UK front-end debt, of course, as we look ahead to the Bank of England decision, currently 344 at the front end. Kriti.
Yeah, a lot to digest. Like I said, a busy 24 hours for central banks, a busy week at that. Policy decisions from, as you pointed out, the Swiss National Bank out earlier, the Federal Reserve yesterday, the Bank of England tomorrow, and you just hit the Norwegian bank as well. Let's get to our team coverage. Joining us now, Bloomberg's Claudia Medler in Zurich, Valerie Teitel, who's been all over the Federal Reserve, and Lizzie Burden right outside the BOE, a truly all-star lineup. Let's start with the Swiss Bureau Chief, Claudia Medler. Claudia, walk us through this Swiss rate decision. The SNB, it feels like, has been in the spotlight more this week than I think it has been in quite some time.
I think Switzerland has been in the spotlight more in the past week than in quite some time. It's obviously been a very eventful week here, and the interest for this for the press conference surrounding the rate decision is so high that they actually had to move it from where they usually hold it in their offices to a hotel. So that just gives you a bit of scale on how important this is globally. So I think globally we're not really looking at the rates as much. Yes, we're rates are going up 50 basis points. That was expected. The central bank kind of said there's nothing really to see here. We're sticking with what was expected. If they'd done less, maybe there would have been concern that the central bank knows more than others. But what's really important, and where I think the president will be fielding lots of questions today at this press conference, will be around Credit Suisse. And the events of the weekend were also mentioned in the statement. The SNB said that the measures taken by them, the government and the regulator, that they put a halt to the crisis, and that the risk was just too great to do anything differently, to the risk to the global financial stability and global financial banking system.
Yeah, as you say, arguably one of the most hotly anticipated press conferences from the Swiss National Bank leader in years. Swiss Bureau Chief Claudia Medler, thank you very much indeed. And of course, do not miss Francine Lacqua's interview with SNB President Thomas Jordan. That is later today. Over to the Fed now. Chair Jerome Powell advised that more tightening may be in store following yesterday's quarter-point rate hike.
If we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on the labor market, on inflation, and we're going to be watching to see what that is.
Okay, Bloomberg's Valerie Teitel joins us now to unpack Powell's comments. Valerie, what stood out to you then from the commentary from the Fed chair?
Look, Tom, it was a dovish hike, and many are concluding that this could mark the turning point of the cycle. Powell's tone shifts to the massive uncertainty and the big unknown that we're going to run right into in the aftermath of this banking turmoil. The key change in the opening statement, which he said recent developments in the banking sector are likely to result in tighter credit conditions. It should weigh on activity and inflation, and the extent of these effects are unknown. He goes on to talk more candidly about the banking turmoil, saying that a pause was considered because of it, and that a significant number of participants anticipated tighter credit conditions are ahead. It could be modest, it could be significant, we just don't know yet, but it can be seen as a substitute for further rate hikes. A bar for another hike in their next meeting in 6 weeks is quite high. They need to be confident that above-trend growth can still be possible, even with this credit contraction. We've seen in the European session so far more hikes priced in the later half of this year, causing the dollar to weaken further.
Yeah, certainly something we're going to be keeping our eye on. Bloomberg's Valerie Teitel all over the Federal Reserve and, of course, the market action that follows. I want to continue with that central bank coverage because you heard Tom this morning. The idea that cable is really trading off of these interest rate decisions is fascinating. The BOE's latest rate decision is due to be published in the next few hours. It comes a day after markets were surprised by hotter than expected inflation data, arguably making Governor Andrew Bailey's decision even easier. Bloomberg's UK correspondent Lizzie Burden outside the Bank of England in London. Lizzie, is that true? Is Andrew Bailey's job easier?
Well, Kriti, like the weather here in London, economists haven't really been able to make their minds up about what the Bank of England is going to do this week. At the start of the week, some of them were saying that because of all this recent banking stress, financial conditions had tightened so much that actually the BOE's job had been done for it. It was time for a hold. There's been a lot of backpedaling since then. Since then, we've had this hot inflation print yesterday. And as you say, it does seem to uncomplicate matters somewhat for the Bank of England. But it'll be interesting to look at the vote split today. We are expecting John Cunliffe to join Silvana Tenreiro and Swati Dhingra in dissenting in favour of a hold. But you might see him actually joining the majority because, of course, he has responsibility for financial stability. Maybe he wants to show confidence in the system. You might also see Catherine Mann, the hawk of the committee, going for 50 basis points after yesterday's print. But look out for that vote split because it'll give us a clue as to whether more hikes are in the pipeline and where rates will peak. Also look out for the guidance because there might be some added language about monitoring financial conditions.
Certainly something we're keeping an eye on, and I think something that the markets are certainly going to be moving off of in just a few hours. Lizzie Burden, we thank you as always. We're going to bring you coverage of the Bank of England's rate decision, that coming up at 8 a.m. New York time. Be sure to tune in. I want to switch from central banks to Wall Street banks. Citigroup CEO Jane Fraser saying mobile apps and consumers' ability to move money with just a few clicks of a button marks a sea change for how the sector manages the risk of bank runs. Speaking with Bloomberg host David Rubenstein, Fraser stressed that the recent string of bank failures was isolated. Take a listen.
The banking system is pretty sound, and we're talking about a few banks. We heard it from the chairman, Powell, today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks.
Shonali Bassick, our global finance correspondent, wakes up bright and early, joins us right here on set for more. Shonali, your initial take on her comments.
These are the most expansive comments we've seen from a bank CEO since this banking crisis happened, but it was important, very important to hear her say this is not a credit crisis and she sees this as an isolated event. She made some news, and remember, it is quite remarkable that she's speaking right in the middle of all of this. She said that SVB could be sold very quickly within a week or so. She also said that these are idiosyncratic issues. She hinted at the possibility here of potentially more issues at other banks, but she gave the sense here that it was still quite contained and this was not a broader market issue. One other thing she said that was very newsworthy is that Citigroup would not consider buying First Republic. Now remember that it is a live situation. She wouldn't comment on it much. She answered really in one word, and that is no. And so we are watching that situation very, very closely, but her sense here was very measured about how deep the pain really runs the banking system. Of course, if you're watching, we all know that everything can change, but her remarks of how calm things are, even though how frantic they seem, is important from her perspective.
And meanwhile, Shonali, look, you were part of the team that broke this story around Coinbase and the SEC. What are the details at this point?
It was pretty remarkable to see this disclosure from Coinbase about an SEC Wells notice because we know that the SEC has been looking at different product lines across different crypto firms and exchanges. But remember, the last time we saw the SEC really go after a crypto exchange was Kraken and its staking service. We did not know what the tack they would take with Coinbase, which remember is a publicly traded, audited exchange in the United States. So this approach they're taking is very broad, Tom. Remember, they're looking at aspects of the exchange, the staking service, as well as the wallet. Coinbase's response is just as important. We know that Coinbase has been fighting the SEC for some time. They've been trying to be constructive. They have been very kind of polite in the way that they have responded to the SEC so far, but this is an escalation, and Coinbase is now saying that they welcome any legal action in response to this. The sense behind all of this here is that the talks between the SEC and Coinbase have really not led led to any conclusions between the two. And remember, whatever happens here between the two of them will really guide how the United States treats crypto. Certainly among anything that is publicly traded among exchanges, there really isn't a lot of action for the SEC among new listings, but also among how crypto is treated here in the United States and how they treat them as securities or not.
So as you say, an escalation, and going to be really fascinating to see, consequential to see how this unfolds. Not taking a knock on Bitcoin right now. That is up 1% in the session, 27,700 for the largest cryptocurrency. Bloomberg's Shonali Basak, thank you on that breaking news, of course, that came through on Coinbase. Coming up, we're going to continue to monitor the Swiss National Bank news conference that is underway. The SNB raised its interest rate by 50 basis points and signaled more to come. But of course, anything they have to say about the crisis around Credit Suisse and how that event unfolded will be fascinating. We're going to talk central banks with Pooja Kumra, TD Senior European Rate Strategist, and Raffaella Tenconi, founder and chief economist at ADA Economics Founder. That is coming up, the analysis. Stay with us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The moment news breaks, no one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Well, it is one day after Chairman Powell's press conference and a Fed decision that everyone said would be historic, 25 basis points on the cards. But look, I don't think it's the rate hike that necessarily has markets in a tizzy, for lack of a better term. I think it's actually the dot plot. And this is really important here because when we're talking about the dot plot, the range of outcomes in just 1 year is crucial. You had folks forecasting anywhere from 2.2% to 5.2% in terms of the peak policy rate of next year. That is a very, very wide range. I think really best shown in this chart, and really the changes you've seen in the median dot forecast. This yellow line kind of shows that the decline that you've seen 4.3%, where you did actually see it as high as 5.25% earlier. That decline is crucial because it suggests, well, hold on a second, where is that decline coming from? Is that from a lack of growth, or is that from an active, more focused way of tackling inflation? Of course, that's going to be what is top of mind when we talk about what the trade is, not just for the next few months, but for the rest of the year going into 2024. I want to get a little bit more context here and be joined by Bloomberg Markets Live editor Eddie Vanderwalt. Eddie, a lot to digest with this dot plot. No one really knows what to make of it. Do you?
You know what, Tiffy is exactly the right word here, because markets are really struggling to digest this. And the dot plot has got a lot to do with it. The fact that the Fed is scaling back its projections shows that they are worried. But I think there was more to it than that. I think Powell also just sounded worried, sounded uncertain, sounded like he's not fully in control, which is not something that we've come to expect from the Fed. The Fed is there to create certainty and let us know that they've got inflation under control and that there's a soft landing coming. But they suddenly are not certain. They suddenly don't know what to do. And I think that is why the markets are so stressed at the moment.
Eddie, arguably, the FX markets are a little bit more certain on where this Fed goes. The dollar is down again 0.4%, 6 straight days of losses. They see a pause, maybe a pivot, maybe those cuts coming through. Does the weakness in the greenback sustain?
Yeah, you know what? I think you're absolutely right. We saw the equity market initially say, oh, this is dovish, we're going to rally. Oh, hang on a minute, maybe there's a recession coming. We're not going to rally. The rest of the market struggled to digest this. The dollar immediately was down. It was like, okay, the ECB, the Fed is less hawkish than the ECB and its peers, or at least that has become relatively less hawkish, and therefore we're going to price accordingly. And I think that remains the case up until the point where the ECB and other central banks say, well, hang on a second, maybe the Fed's got a point, maybe we shouldn't be quite as hawkish as we are. And I think there is a chance that this is the first ripple in a wave of central bank capitulations.
Does the euro become the next safe haven, or is that a stretch?
I think the euro, putting money in the eurozone as a safe haven, it seems far-fetched. But Europe is doing very well on the reopening of China. And, Europe is a much more stable trading partner for China at the moment. And I think that, therefore, money seeking a home will go to the euro as well as to places like gold.
All right, that really interesting China component in the euro story. Thank you. Eddie Vanderwalt, of course, on the prospects for the greenback and the single currency in Europe from Bloomberg's MLive team. And for more market analysis, do check out MLive Go on your terminal. Well worth it. Stay with us. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Now keeping you up to date with news from around the world, here's the first word. Treasury Secretary Janet Yellen says the U.S. is not considering blanket bank deposit insurance without working with Congress. A Senate subcommittee had asked Yellen whether protections for all U.S. deposits would require congressional approval. She also said that the heads of recently failed American banks should be held accountable. Top executives at First Republic Bank have agreed to forego their bonuses for 2023 and some other pay. The bank has lost more than 88% in market value this year. It's grappling with a crisis in confidence in some regional banks. Washington and the banking industry have been trying to keep First Republic from becoming the next bank to collapse. Across the Atlantic in France, more strikes are set against President Emmanuel Macron's push to reform the pension system. Public transportation, schools, and refineries are likely to be impacted. It's now been more than 2 months since French unions began a series of walkouts and marches. Macron wants to raise the retirement age from 62 to 64. Neither billionaire Jim Ratcliffe nor the Qatari consortium interested in buying Manchester United have reportedly submitted improved bids for the British football club. According to Sky News, both bidders have been granted extensions to last night's deadline to increase their offers. The groups are competing to acquire the club from the American Glazer family. Now, Tom, I don't know a ton about Man U, but I do know that Cristiano Ronaldo used to be part of that team amid quite a bit of controversy. But I gotta say, I'm still a Ronaldo fan, and I think I might just get canceled for saying that.
Yeah, listen, this is a bold comment. He's very divisive. Some people love him, some people really do not. What I'm caring about, though, is the league table, and it's quite satisfying as an Arsenal fan to see Man United in third, but that doesn't tell the whole story. They're a full 19 points below Arsenal. But yes, the bidding process is really fascinating. Two big bids coming through. Maybe some more will join. There were 20 bids, by the way, for the outset for Chelsea, so that puts into context the appetite for Man U.
Yeah, I gotta say, none of that registered. I don't know what you just said. You're gonna have to explain it to me in the commercial break for sure. Coming up on the show, Pooja Kumra, 2ED's senior European rate strategist. It's an interview you do not want to miss on the back of these central bank decisions. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed makes it clear, despite the banking crisis, fighting inflation still is its main concern. And more central bank moves on interest rates. The Swiss National Bank hikes by 50 basis points. And the Bank of England decision is later today. And a game changer for bank runs. Citibank CEO Jane Fraser warns that mobile money marks a sea change for both bankers and regulators. I'm Tom McKenzie in London with Kriti Gupta in New York. Anne Edwards and Matt Miller are off today. And Kriti, there seems to be a uniformity in the message that we're getting from central banks. Their primary concern remains inflation over and above financial stability, at least for now.
Yeah, price stability versus financial stability is certainly the question. It's something that has almost been priced to perfection, at least in the equity market. And I think that's why you're seeing a little bit more bullish sentiment when you look at futures trading this morning. And I'd argue on the back of stocks yesterday as well. Take a look at the S&P futures higher by about 0.5%. But I really think all the actions in the bond market here. But look, if you were forecasting a terminal rate of still 5.1%, yields should be higher in theory. They are not. They're actually below that 4% threshold for the front end of the curve. The two-year yield sticking below that 4% technical level. Now, this is really important when we come to whether or not the bond market is accurately pricing in what the Federal Reserve is telling them to, especially for the dot plots. The problem is in the ranges. You are starting to see a lot of uncertainty in terms of what the message really was from the Federal Reserve, not for this meeting or next meeting, but the long-term picture. And that's going to have repercussions into the currency market as well. Take a look at the dollar here. You are seeing weakness by about 0.3%. A lot of that driven by perhaps expectation of those hikes out of the BOE, out of Norway and out of Switzerland as well, pushing back on the dollar. Does that bounce back in the coming days? NYMEX crude as well, 70 handle, Tom, as we were talking about the inflation story, creeping up slowly, but perhaps not at that 100 call that we were hearing about just a couple of months ago. Some pre-market movers as well that you should know about. Let's start with Virgin Orbit, soaring by about 9%, saying it's targeting, quote, an incremental resumption of operations after temporarily halting activities last week. Like I said, up in the pre-market, surged by a record yesterday. This is a name you want to go watch. VORB is your ticker there. PacWest also in the news, given all of the banking uncertainty after First Republic, after Western Alliance, now moving to shore up liquidity to protect itself after customers pulled 20% of their deposits since the start of the year, something investors seem to be smiling upon in the pre-market, higher by about 5%. We got to talk about Coinbase as well. This is moving in the opposite direction, down by almost 10% in the pre-market after receiving a notice from the SEC declaring its plans to bring an enforcement action against the crypto exchange. This is some legal action we've been waiting for, some direction, certainly not working in Coinbase's favor, Tom.
Yeah, Kriti, here in Europe, the sentiment has turned a little bit more negative. You're seeing the benchmark down 0.8%. Again, investors digesting that move, of course, from the Federal Reserve, but also the Norges Bank and the SNB, really with that focus on inflation and outlining what they say are the reduced risks around financial stability in the banking crisis. So a bit more of a heavy sell-off, and we'll see if that sustains through the rest of the session. It was a decent session over in Asia, and largely as a result of softer dollar and some earnings results coming through from Tencent over in China. The Swiss franc is up about 0.1% versus the US dollar, purring some of its earlier gains. Again, the Swiss National Bank hiking by 50 basis points and suggesting that further hikes could be in the pipeline. The pound in focus for us today, ahead of that Bank of England decision. We know there's a big debate amongst policymakers at the BOE. There is an expectation they will go 25 basis points. The pound up 0.4% at 123. And gilts, of course, remain in focus for us today, again, tied to the action of the BOE. 342 at the front end, a move of 6 basis points. Kriti.
Yeah, certainly something we're going to keep an eye on when it comes to the rates picture and the fallout in the currency market as well. Joining us now to break it all down, Pooja Kumra, TD Bank Senior European Rate Strategist. Pooja, you join us on a momentous 24 hours. Let's start there. Of course, we have what I think a lot of people are calling a dovish hike from the Federal Reserve. You also have the BOE as well. Are the interest rate differentials perhaps more important now than they were, say, a few months ago?
No, definitely it will play a key role right now, especially we saw I know Fed, there were not many people who were expecting a 25 basis points hike from Fed, but the overall message was pretty much very dovish. If you look at their unemployment rate that they are looking at, they are actually suggesting that unemployment will increase to 4.5% from current 3.6%. They gave us a dot plot with no changes. I think financial price stability is their key mandate, but they are turning towards financial stability. And if you look at the entire bank situation, it's currently centric at US. So I think that will be the key driver. So far, UK banks have still not been that much affected by this entire move, but no bank will left affected by anything that happens, whether it's CS or whether it's SVB, or they will all trade together.
Yeah, indeed. Pooja, look, you've brought forward your terminal rate, your forecast for the terminal rate when we hit that for the Fed, and you've brought it in lower. Just unpack that view for us.
So with respect to our terminal rate, we are still looking at 5.5, which is actually 25 basis points higher than what Fed's dot plot says. Again, there are risks skewed towards Fed sticking to the dot plot or even actually stopping here. So what we will be watching is the next few, I should say weekends, if there's no blow up with respect to other banks. I think when it comes to general labor data, inflation data, no one will actually say that at this stage Fed needs to stop. But they have given us a clear indication at this stage that they are watching credit lending standards, and that will be the key driver for them to come to reach price stability. So I think next 1 or 2 weeks will be very crucial for the banking sector, and we will also be looking at with respect to this deposit insurance scheme that we can get from US. And I think if the path is clear, it's more likely that the Fed hits their terminal at 5.5, but we are being very humble about it.
Okay, you're being humble and you're still zeroed in on the banking story. We were speaking to TS Lombard earlier. They have a view that rates get down to 2.75% by the end of the year. Yes, 2.75% is the call from TS Lombard by the end of the year. Significant rate cuts coming towards the end of the year. Do you align with that view? Are cuts coming in towards the end of 2023 for the Fed?
Certainly, Fed did not align with that view.
No.
I think at this stage they will have to resist cutting rates just given the fact that inflation still remains above their target. But we also know that if things worsen further, they will be left with no choice. Fed was pretty much clear about the fact that they have never seen a deposit run of this scale ever. And I think that was pretty much tells you all that they are worried. So as we said, that we will be watching a couple of weeks, but it's hard to see Fed cutting rates so much in this year. We are still expecting for a 25 basis points rate cut later this year, and I think that should cement the view for further cuts in the pipeline.
Which is certainly a view that I think some more banks are starting to roar up to. I know Allianz, for example, having a similar call in the back half of the year. But Pooja, I'm very confused about the 2-year yield right now because you were seeing it at 3.95. Why is it staying below 4% 24 hours after, or less than 24 hours, I should say, after the Fed hiked 25 basis points? Explain the logic there.
First of all, rates markets have no logic. I think one thing whenever in terms of rates is the positioning. we did see a lot of sell-off going into the meeting, and I think that kind of rollover that we are seeing in terms of the front end. And also we do also expect that whatever state treasuries does get that kind of safe haven asset yield, and I think that will continue to be the case in the coming months. And that's why when it comes to treasuries, we are looking for 10-year treasuries to end the year at 2.75, just because they do have that kind of protection that markets want at this stage.
But how does that work then if, it feels like in the fallout of the banking crisis, a lot of the issue was a lack of hedging duration risk. If there is now perhaps a move to correct that, shouldn't yields by definition go higher simply by more people shorting the front end?
No, yes, there is a way to look at that as well, but I think what even Fed has provided all these banks is that you just park treasuries to us and we will give you lots of money, right? Like they are trying to prevent that, the liquidation of assets. That was one of the scare that could have taken treasuries much higher from the current levels. I think what 2-year treasuries right now are pricing is the fact that the Fed will be forced to cut rates. And the moment, if markets do see that kind of pricing to continue, we would expect the 2-year to get bid, and we would expect the two stance curve to actually re-invert, which has been the general direction for the curve across board. We have seen that steepening move. So as long as we have cuts remaining, 2 years should get support. And the moment markets feel that the financial crisis is over, they can remove cuts from here, in fact, play a bearish trade. At that stage, we will see the 2-year getting hit. But for now, I think it would be hard for markets to actually price in much in terms of rate hikes for the next meeting.
Okay, a reinversion of the curve and the view on that. Currently, the 2-year at 3.95, the 10-year at 3.46. Pooja Kumra of TD Bank with the view that you're going to get a 25 basis point cut by the end of this year. Thank you very much indeed for the analysis. Let's just recap the lines coming through from the Swiss National Bank after they hiked rates by 50 basis points, in line with the view from Bloomberg Economics. But arguably, it's more important to zero in on the comments around the Swiss banking sector. So Thomas Jordan, the head of the Swiss National Bank, saying that supervision has to be adjusted to the new situation. Swiss banks are not exposed to US bank failures. That's according to the head of the SNB. Jordan saying he won't say if he knew March the 15th that Credit Suisse could not survive. And of course, Francine Lacqua will be sitting down with the SNB president, Thomas Jordan, later today, and you can expect her to probe him on those issues and how the fallout of Credit Suisse came to bear and the decision-making around getting UBS to acquire that business. So lines crossing again from the SNB. Jordan will not comment on the decision to wipe out Credit Suisse's additional Tier 1 bonds. That's the latest line coming through. And again, we'll be getting Francine Lacqua and that interview with the president of the SNB later. Coming up next, Raphael Tekanuri, the ADA economics founder and chief economist. We'll get more views, of course, on the Fed, the BOE, the ECB, as we weigh up these inflation risks versus the banking crisis. Stay with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Inflation remains too high, and the labor market continues to be very tight. We no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. If we need to raise rates higher, we will. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Our banking system is sound and resilient with strong capital and liquidity. We're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. When a bank fails, there are investigations, and of course, we welcome that. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. At the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Fed Chair Jerome Powell, of course, speaking yesterday after the central bank raised interest rates by 25 basis points. Joining us now is Raffaella Tanconi, ADA Economics founder and chief economist. Raffaella, thank you for joining us this morning. So I look at the top end now for the Fed of 5% in terms of the range. And then I think about Torsten Stock from Apollo Global and his analysis that the financial condition tightening that we've seen as a result of the banking crisis is equivalent to 1.5% rate hikes from the Fed. So you layer that on top, you're talking 6.5%. Again, if you take into account that analysis, 6.5%. Are we getting close to a policy mistake here, Raffaella?
Hi, good morning. I think 6.5% incidentally is where we thought the policy rate would be the most aggressive and would significantly harm the housing market. So to some extent, I think the message is we're very close, so we are at the peak of the cycle. So the question has shifted away from where the peak is into where is the cost of capital in the medium term, especially in 2024, and how fast are we going to get to that sustainable level? Because that actually is what defines whether you're going to get enough productivity and enough gentle adjustment into the economy.
So draw us out to the end of the year then. Will markets have to adjust to a Fed that's going to need to cut more aggressively than maybe the markets are anticipating?
Well, we think into the end of the year, you'll definitely see more data that the economy is slowing down. I think from a cyclical perspective, the inflation is going to look better. But also from a structural perspective, I think it will become evident that we have pivoted to some extent. It's not just the housing market that is going to correct downwards, as in lower activity and less inflationary, but also I think the technology sector is entering a serious restructuring phase that is relevant for growth and inflation long term. And there may be a third sector that eventually ends up being a collateral damage, which is discretionary and luxury.
Well, if
downturn and a structural moderation.
Raffaella, to your point, if you start to see deterioration in those sectors, it feels like it would have to happen fairly quickly, given that we are, at the end of the day, at the end of March. How quickly do you see that signs of that early deterioration in those sectors showing up?
Well, I'm both telling you short-term and long-term trends. So in terms of housing and technology, you begin to see the signs, right? I mean, you've seen lowered mortgage creation. You're seeing some job cuts in technology. But to see the full new long-term equilibrium, so to speak, I think you'll probably need to wait, or it will be clearer next year. For technology and discretionary, I think there is also a regulatory evolution, so to speak, that usually takes quarters. But, I mean, financial markets usually look forward, right? So at the end of the year, I think these themes will already be at the center stage. And to go back to Tom's previous question, I mean, the Fed, I think, can stay on hold from here until most of the end of the year. It could certainly open the door already before the end of the year to easing. at this stage, we still expect the bulk of the rate cuts in 2024.
Rafaela, one of the kind of hot takes on Wall Street comes from Mark Zandi over at Moody's. He says that the Fed doesn't actually need to hike rates anymore because the practices to address the issues in banking itself are going to mean tighter lending standards. It's going to mean kind of a crunch on credit broadly, and that is going to do the job of the Fed. Do you agree?
Yeah, I agree in essence. I think yesterday's hike was largely unnecessary for the economy. Perhaps it was in any case useful for the market because it was a relatively gentle transition. I mean, we had an abrupt change of tone from very hawkish to now dovish. We had the dot plots, which kind of cements the outlook. And the door is open for May to both a pause or a hike. If we are in a blue sky scenario and I turn out to be too bearish, and actually the economy is stronger, he can still deliver a final hike. So I think it was really unnecessary, but not harming.
Okay, an unnecessary hike from the Federal Reserve, but not too much damage to be done given the dovishness of the communication. And the bulk of those cuts, the expectation there, are going to come through in 2024 from Rafaela Tencati. Thank you. We appreciate your time of ADA Economics. Right, coming up, a game changer for bank runs. Citigroup CEO Jane Fraser describes how risks have changed for banks in recent years. Part of our interview is up next. You want to tune in for that one. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Citigroup CEO Jane Fraser says the U.S. banking system is sound and the fallout from the recent string of bank failures is not something that will spread across the industry. She spoke with Bloomberg host David Rubenstein at an Economic Club of Washington event. Take a listen.
The Fed's job number one is fighting inflation, and we want the Fed to be very dependable in fighting inflation, and that should be their most important priority. There are ramifications of it, but there are certain banks, which I say are an isolated few, that have really been impacted very negatively, that didn't necessarily manage their balance sheets that well in retrospect.
All right, in the Great Recession in 07, 08 or so, the U.S. government passed TARP legislation. And under the TARP legislation, large amounts of capital were injected into banks, including Citi.
Indeed.
Some banks said they didn't need it, but everybody took it who was offered it or forced to take it. And effectively, that meant that the shareholders, the creditors, and the depositors were all protected. This time around, Silicon Valley Bank was only the depositors were protected over a decision made by the Biden administration, others over the weekend. Do you think that was the right decision to protect only the depositors and say goodbye to the shareholders and goodbye to the creditors?
I think it's very important to protect the depositors. Right now, the banking system everywhere around the world depends on confidence, and that confidence has to be in the safety and security of deposits. So in terms of the most important job here, they did the most important job, which is making sure the depositors were whole.
So in the old days, when there were bank runs, you used to see people lined up outside the street and get their money out. Now, you just on your iPhone or whatever phone you have, you can take your money out. So money moves so quickly. Was that a factor as well in having the money get out of a bank so quickly? You don't have to wait in line. You can just do it over the
It's a complete game changer from what we've seen before, David. You're absolutely right. There were a couple of tweets, and then this thing went down much faster than has happened in history. And frankly, I think the regulators did a good job in responding very quickly, because normally you have longer to respond to this. So they acted with quite a lot of speed, given how quickly this happened.
So some people say you have a moral hazard when you protect people. So by protecting all the depositors in Silicon Valley Bank, the implication was that if somebody else has a problem, we'll protect them and so forth. And so the $250,000 limit is meaningless, more or less. Or do you think the Federal Reserve and the Secretary of Treasury are saying we're not going to protect every depositor, or we're going to protect certain depositors?
I don't think they need to go out right now because the banking system is pretty sound, and we're talking about a few banks. We heard it from the Chairman Powell today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks that have some problems, and it's better to make sure that we nip that in the bud.
Okay.
And you can watch the full conversation with Citigroup CEO Jane Fraser on the David Rubenstein Show. Peer-to-peer conversations on March 29th at 9 p.m. New York time. Let's stay with the banking crisis then, the anxiety in that space. With lines coming through from the SMB head, Thomas Jordan, saying that a spin-off of the Credit Suisse Swiss unit, which we know is one of the most prized and valuable parts of the Credit Suisse business still, is not on the table. That line coming through from Thomas Jordan, Kriti. Important in terms of the clarity, at least around how Credit Suisse and UBS plan to move forward.
Yeah, and certainly as we see and hear him speaking, we are also seeing movement in the Swiss franc against the dollar. 109 on that handle, Tom. A lot to digest there.
Yeah, and of course, do not miss Francine Lacqou's interview with the SMB president, Thomas Jordan, later today. They raised rates by 50 basis points, and he reiterated that the UBS takeover of Credit Suisse moves the financial stability risks out for Switzerland. This is Bloomberg.
specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War, it's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
What's happening among the banks and asking, is there going to be some tightening in credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Split-screened chaos in Washington, D.C.
Well said.
That was yesterday. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures nicely positive, up 0.5% on the S&P 500. Lisa, this market got into a difficult moment at one point yesterday afternoon, but it wasn't about Chairman Powell. It was about the Treasury Secretary.
That was what I found interesting. Chair Powell did an excellent job being really boring, basically towing a line that really didn't disrupt anything and left the market in pretty good shape. And then Janet Yellen came out and was like, yeah, about those deposits, they're not guaranteed. We haven't discussed it yet. We don't think that this is necessarily going to be on the table. And all of a sudden, and you can interpret those comments however you want, but the market clearly interpreted them as there was no backstop for deposits, as she had basically hinted at earlier. And that had a pretty big impact on some of those bank shares.
So earlier in the week, she possibly teed up using the systemic risk exception to make depositors whole. I think there's a key distinction here. There's a difference between doing that again and having blanket deposit insurance. I think the difficult part of this moment in this market yesterday is that the day before, people misinterpreted those comments, the underlying meaning of what she was really trying to imply.
She can't do that, though, on a longstanding basis without congressional support. And she was speaking to Congress, she was speaking to the Senate, and I think that that's telling. There isn't the congressional will to make this happen. So if she's talking about what her proposal is, what I'm curious about is whether we end up with a legislative stalemate that she's trying to reflect in terms of what her capacity is to do.
This was the point of tension for Secretary Yellen last week as well, when she was on Capitol Hill testifying. She can't square this circle. At the same time, you can sit there and say, if we have these kind of troubles again, and we think that there could be contagion, then we can have that systemic risk exception and make depositors whole. That's a big difference, a big difference between that and saying we're going to have blanket deposit insurance. The problem was for Chairman Powell, he comes out in the news conference at the very top and says deposits are safe, banks are safe, the system's robust. And at the very same time, Secretary Yellen is saying that. It's the conflict between the two at the same time. That's really poor scheduling. You know, when Chairman Powell's speaking, I don't know how this stuff works. So I'm going to speak to Anne-Marie a little bit later and ask her, how do these kind of things get scheduled? And can't they just reschedule them when they find out that she's going to be speaking at the same time as the Fed chair?
You would think, and I don't know that it's scheduling either, but I'll just tell you Steve Chiaverone's take on it because I thought it was quite funny. It's astounding that Yellen and Powell would have given contradictory messages on bank deposits at the same time. Powell essentially said that all deposits are safe. Yellen said, hold my beer. You would have thought that they would have coordinated. I mean, that really is the tell from the market.
We talked about this yesterday. You'd think they had spoken to each other, wouldn't you?
I mean,
clearly, why wouldn't they have spoken to each other?
The fact that they haven't doesn't exactly imbue you with incredible amounts of confidence that they have it all together.
It was kind of bizarre yesterday. Futures bounced though this morning, so let's whip through it. Equity futures up by 0.5% on the S&P 500. Bonds look a little something like this. On the Treasury curve, unchanged for once on a 2-year, 3.94. Yesterday, we had a 25 basis point hike from the Federal Reserve, and the 2-year yield lease dropped 20 basis points.
Well, and we heard from Fed Chair Jay Powell after Michael McKee's great question that they had no rate cuts priced in, and the market saying, yes, you do. You have almost 100 basis points of rate cuts priced in. At least that is the market pricing right now. So, you know, what people are believing, I'll leave that up to people to decide.
What's coming up?
What's coming up is more central banks. We have Turkey and the Bank of England following Norges Bank and the Swiss National Bank. Swiss National Bank just raised rates by 50 basis points. 11 a.m. we hear from Bank of England's Catherine Mann. She's speaking at the Peterson Institute as a panelist. The Bank of England expected to raise rates by an additional 25 basis points. And here's where I think we're going to start to see more divergence in the currency, more potential dollar weakness. This is what people are speculating, not incredibly, but if you start to see the Fed pulling back and European banks still seeing hot inflation further behind in terms of the rate hiking cycle, do you get this divergence where it's all systems to go on the rate hiking over in Europe and not so much in the U.S.? We haven't talked about this that much, but I think we should. 10 a.m., TikTok CEO is coming before the House Energy and Commerce Committee. John, you mentioned yesterday, what do we end up getting if we hear from politicians who just are basically using this as a campaign pitch point? There will be some tell, though, what the appetite is to actually do something on this front. I mean, I think it'll be interesting to see what proposals he has.
I'm surprised they haven't done anything already. This is a hangover from the previous administration. Why is this taking so long?
It's not popular. That's why. I mean, I can't think of anything else. They advertise. They do campaign advertisements on TikTok. So at what point can they basically square the circle, if you want to use a similar type of analogy? And at 3 p.m., we hear again the redux of Treasury Secretary Janet Yellen. Will she clarify her comments after tanking bank stocks yesterday with her lack of support necessarily of ongoing deposit insurance? I am watching the KBW Bank Index today. Do we see some sort of reprieve? Yesterday, ongoing concerns about First Republic, PacWest coming out saying that they got a line of credit, that they saw 20% of their deposits withdrawn in the first part of this year. How do we stave that off, especially if Janet Yellen is kind of waffling and giving contradictory messages to what we hear from Jay Powell?
You know what we've learned in the last week? People thought that the ECB had delivered the playbook for Chairman Powell. That's not the playbook he reached for. We've learned that Credit Suisse is not a substitute for rate hikes at the ECB. But the financial instability in America is a substitute for rate hikes at the Federal Reserve. That's a key difference. And to your point, you mentioned this a little bit earlier, that opens the door potentially for some divergence between what you expect from the ECB and what the Fed might deliver in the next couple of meetings.
And there are a lot of questions that emerge from that, but that to me is one of the big themes that's really a pivot point that's new.
Joining us now in this equity market, John Stolfus, the Chief Investment Strategist at Oppenheimer Asset Management. Hey, John, great to catch up with you, sir. I mentioned this during the commercial break. We're going to talk about exactly this. If the Fed backs away because things are breaking, are you telling me that's bullish?
No, it's certainly not a bad thing. Let's put it that way. And I think the market really responded to that intimation from Chair Powell, and I think that that was all really doing quite well. Later on, we had this from Secretary of Treasury Janet Yellen, and that kind of shook people up. But this is not uncommon. Times like this, the main thing, it's not so much what brings the market down, is how quick the response is, and a recognition investors need to realize not every response is going to be correct or exactly what they want to hear, but it's a process of working our way back out of another set of wooded areas, so to speak.
The setted wooded area we're going to get out of somehow with rate cuts. That's what the market says. The Fed says no. How much are you counting on rate cuts to have a more bullish outlook on how this emerges, how this develops, how we emerge from the woods of financial systemic issues?
Great question, Lisa. Not really relying on rate cuts a heck of a lot near term. I think the inflation is sticky. The Fed has to do something. Its credibility is still on the line, but its credibility is always on that line, whether it's a rate hike cycle or a cutting cycle. But in this particular instance, having been behind the curve badly enough, so we had this inflation hit the 40-year highs the way it had, this is an important period. And they've got to show that they can manage both this as well as a crisis in confidence within the regional banks. And I think they can, and I think they're very capable of doing it. But it doesn't mean they are infallible. They just have to work their way through a process.
John, you've been a bullish investor for quite a while. What does being a bull right now mean? What does it mean owning, and what does it mean hoping for?
Well, I think the main thing right now is, we've just been building our positions in areas that we think will be rewarded. And if I just take a look, and I hate to give the Bears, some areas they might hit, if they get bugged out today at some point. But it's been terrific, where all of a sudden tech has become the new value story. There was a recognition all of a sudden that indeed we're not going back to the abacus or going back to the slide rule. Technology is alive and well. The most important thing is it's got to be profitable. Positive cash flow is a good thing. But as well as that, it looks good for consumer discretionary. It looks good for areas, communication services, industrials. And this is the area where we like to invest, not play. A little bit longer on the financials now. This is going to take to regain trust in terms of investors who are not players, but rather intermediate to longer term investors. It'll take them a little while to feel more relaxed about financials as this gets cleared up.
Well, we need the consumer to relax about financials before investors can relax about financials. John, you need policy to act as a circuit breaker. Do you think this financial instability can end without blanket deposit insurance?
Yeah, I think that the real definition is will have to be perhaps a redefining about what that maximum amount of a deposit that gets covered, and then anything over that would likely have to be paid by the depositor in being over and having an overage versus what the covered amount is, so that the taxpayer is not really on the hook for it.
John Stolfus of Oppenheimer Asset Management. John, thank you. Lisa, what do you make of that?
Thanks.
I just love that he didn't want to give anything to the Bears to chew on in any way, shape, or form. So he talked about how it might take a little longer for tech to come back, which is basically like, perhaps it will lag behind in the near term. I will say, though, what he's talking about is probably the bull case at a time where you still have optimism in the economy, you still have momentum, and you still have a story of resilience in a lot of sectors that even if you get, a rocky road over the long term, you could lift.
Can I ask that question of you? Can this end without blanket deposit insurance? Can this financial instability end without it?
It's a great question. I think without consolidation, mass consolidation, and perhaps a greater degree of regulation, here's the question. Would these banks and would politicians rather have a greater degree of regulation that changes the business model and reduces the profitability case for lending? Or would they rather provide a backstop to depositors in a way that they really haven't before? And those are really the two issues that they're dealing with. Either way, there has to be some policy change to revive the confidence that they're not going to be subject to this. I mean, Jane Fraser yesterday basically saying this is a new terrain given the speed of which Silicon Valley failed.
Extra regulation is guaranteed, isn't it?
You would think so, but I can't imagine that a lot of people are going to be really gung-ho about that if that crimps their local regional bank. I mean, really, because these are very direct. It's like the Bundesbanks in Germany. Every politician has a Bundesbank, so they don't want to consolidate them. It's sort of the same in the U.S. with regional banks.
It's a nice analogy, comparison. Where'd you read that?
I just made that.
You just made it up. You just made it up on the spot. You're making things up.
Let's move on.
Are you making things up?
No, I'm not.
Okay.
No, it's true.
That's a good start to the morning. Don't worry, we haven't slept for a week. Futures right now on the S&P, positive 0.4%. Broward's going to make things up for the next 2 hours. Yields 3.48 on a 10-year, higher by 4 basis points.
is click on our feed, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Fed Chair Jerome Powell made it clear that inflation is still the top concern of the central bank. Less than 2 weeks after the second biggest bank failure in U.S. history, Powell advised that more Fed tightening may be in store following Wednesday's quarter-point rate hike. Officials are betting that the bank turmoil won't turn into a broader financial meltdown. The Bank of England is likely to continue the quickest set of interest rate increases in 3 decades. Investors and economists expect the BOE to raise the benchmark lending rate by a quarter point. Those expectations were solidified Wednesday when new data showed inflation climbing in the UK for the first time in 4 months. Treasury Secretary Janet Yellen says the U.S. is not considering blanket bank deposit insurance without working with Congress. Now, a Senate subcommittee had asked Yellen whether protections for all U.S. deposits would require congressional approval. She also said that the heads of recently failed American banks should be held accountable. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals, which the U.S. has still rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The moment news breaks, no one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
So Chairman Powell did his job. Your deposits are safe. At the very same time, there was this exchange with Secretary Yellen. Take a listen.
Madam Secretary, does insuring every deposit at every FDIC-insured bank in the nation over $250,000 require congressional approval?
This is not something that we have looked at
it's not something that we're considering. That would be a case-by-case determination.
I understand,
I
and
have
that-
not considered or discussed anything having to do with blanket insurance or guarantees of
2
full
points.
deposits.
Secretary Yellen there, Lisa, that one is a point of attention.
Considering that she basically flagged that that was what they were considering earlier in the week when we had reports that this was what was on the table to prevent this kind of lack of confidence going forward. And clearly, markets had a pretty significant response.
I keep going back to this point. There is a difference if a bank is failing and it poses some kind of systemic risk, the potential possibility of contagion, then they can come in, use that systemic risk exception and make depositors whole. That's just about all the Treasury Secretary can say, because we've reported that maybe they are looking at blanket insurance, but she's not willing to say any of this on the record at all.
Which is part of the questions, the existential questions facing the regional banks. We were talking earlier, Landesbanks, not Bundesbanks, but the Landesbanks in Germany.
Oh, you should do this again. This is good. Go on.
It's actually an important, it's a relevant comparison because the Landesbanks, people say there are a lot of them and they're all too small to kind of really be on their own and be successful, but they're not merged because each politician is sort of the representative, you're laughing at me, of that bank. And in the US, I wonder if there's some sort of similar feeling of regulating too harshly some of the regional banks that are the mainstays of certain communities.
Well, what do they do now? There's quite clearly a two-tier banking system in America in the minds of so many people. How do you solve that? What do you do?
I have no clue. If it's not deposit insurance, what do they look to do? Because if it's not more regulation that's going to crimp their business models, how do you then get them together?
You're just hoping it goes away?
Well,
Chairman Powell doesn't hike anymore and it just kind of disappears?
What do they say? Hope isn't a strategy?
Something like that.
Yeah.
You need a policy.
Correct.
It's not clear what the policy is.
Well, Janet Yellen has a chance to clarify that later today.
Again. Looking forward to that. Equities right now positive of 0.4% on the S&P 500. A lift here, yields up 4 basis points. Your 10-year 347.72. Looking at the euro against the dollar, just south of 109, 108.74. Euro dollar positive 0.2%. Stephen Vicker joins us now, Financial Institutions Research Director at Argus Research. Stephen, wonderful to catch up with you. I'll ask the question I asked John Stolfus about 10 minutes ago. Can you address this financial issue without blanket deposit insurance?
Well, I think you can. You know, certainly there's been a little bit of back and forth on this topic, and Treasury Secretary Yellen is not ready to, fight that battle, or so it seems. So there may have been a little disappointment on, the lack of being constructive on that. But at the same time, I think, something like the yesterday's news by Sophie Technologies is a novel approach and may bring into the fray a industry solution, which is banks get together in a consortium type of way and insure deposits up to $2 million. And, I think that's definitely a novel approach. I think it could even be a differentiating factor for banks that are part of this. Hey, look over here, we'll insure your deposits up to $2 million. Well, your other bank only goes to $250,000. So I think there could be an industry solution. And, really at the same time, I think they, and Chairman Powell left open the possibility that if a bank is truly failing, that they will, still step in and save depositors. So I don't know that this is going to be, necessarily an issue that that either depositors or investors need to not be able to sleep well at night because of.
Stephen, were you surprised that the Treasury Secretary said she had not considered or discussed a blanket insurance or guarantee of deposits? Are you surprised she hadn't considered it or discussed it?
Well, yes, especially since previous comments would have indicated that maybe she would. Maybe she sort of read the tea leaves and said, this is not something I'm going to be able to get, certainly not get through easily, and I'm not willing to, die on the fence for, and just backed away from it. So, it would be nice to have that additional backstop, but I don't think it's industry critical.
If it doesn't come to pass, which seems increasingly likely by some of the rhetoric that we've heard, Stephen, then doesn't that reduce the profitability model substantially for regional banks?
Well, it does, and I think we're looking at heavy regulation here because of this episode that is bound to hurt industry profitability. It will add to the safety and soundness aspect, but I think we're looking at stress testing for smaller and mid-sized banks that will push down to lower asset sizes, and more banks deemed to be critical and systemic. Stress testing for these wider array of rate environments, particularly on the higher side, which is not the base case in the severe adverse scenario. You get potentially higher deposit insurance premiums. The FDIC took a big hit, obviously, in this episode. Cost of capital is probably going to move higher as well, and greater liquidity cushions, if not additional capital cushions as well.
How do you stress test against tweets?
Well, you make sure your bank is not what Silicon Valley Bank was, which is a high proportion of uninsured depositors and deposits that were simply not well diversified at all outside money-losing startups. I think that's, you start right there. And you have, better regulation that will protect the investment portfolio from rising rates. In the case of Silicon Valley, you had just a flood of deposits in the 2000-2001 period, and they invested it at just the wrong period in longer dated securities. So you have to shy away from that. So I think there's three things there that are avoidable, and that Twitter will not allow or should not allow a run on your bank if you stay away from those three in particular.
Hey, Stephen, we've got to leave it there. Thanks for being with us. Stephen Bigger there of Argus. The situation continues to evolve. Lisa, tweets are the accelerant, not the fuse. I think this idea that bank runs happen more easily with Twitter, I understand that. They can happen more quickly. What started this, though, was just a poorly managed bank, and a lot of people running for the exit because of that.
I would agree with that, and that's definitely what's borne out by the balance sheet. And when you look at some of the mismatches, that said, I wonder what kind of protections there are against tweets. I mean, Bill Ackman coming out overnight after hearing what Janet Yellen said and basically talked about how, he expects big deposit runs because of the lack of insurance. Totally free speech, go for it. At what point, though, is there a sort of some kind of concern? I mean, where does free speech and, something that impedes the financial system, where do the two leave off, especially when there's investment that takes place?
I'm with you. So to regain that trust with the consumer, with the people of this country right now, I keep going back to the same question. Can you address this without blanket deposit insurance? Stephen mentioned there could be an industry solution where the banks get together and just have to do something themselves.
And he pointed to SoFi, which yesterday announced this plan to actually increase the insurance to $2 million from $250,000 in FDIC insurance, and had gotten together with other banks to do this. Again, though, that goes to the profitability question. If you start getting private sector insurance solutions, great, solving the problem through the private sector, it's going to cost something. And does that make the model more difficult and, at the very least, impede some of the lending that these banks traditionally have done?
The future's just rolling over a little bit here. We're still positive by 0.2% on the S&P. I know a lot of you are watching First Republic. That stock is positive by 1.9%, which is kind of like unchanged relative to what we have seen over the last week. Had another downgrade, another credit rating downgrade, this time from Fitch. Those downgrades just piling up over at this bank. Francis Donald up next from Manulife. Looking forward to this conversation on the latest change from the Federal Reserve.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City this morning. Good morning to you all. Equity futures right now on the S&P 500 positive by about 0.25%, fading just a touch on the S&P 500. On the Nasdaq, we're positive 0.8%, a lift there after a big move again in the Treasury curve yesterday, down 20 basis points at the front end, even after a 25 basis point hike from the Federal Reserve, because we are going who knows where on the FOMC now. The median dot stayed unchanged at 5.1% from the December projections. Looking out ahead in the latest projections for March and the March meeting from yesterday, your 2-year at the moment 3.95, so south of 4 again. We're higher on the session by about a basis point, but much lower over the last month or so. The 10-year yield higher by 3 basis points, 346.59. We're all fixated on the difference that's emerging now between the ECB and the Federal Reserve. Early on in the session, the euro 109.30 against the dollar. Right now 108.71, positive about 0.1%. Bramo, I'm with you. This is one to watch here. The language from Lagarde, nothing like the language from Chairman Powell.
This is a pivotal moment, I think, this week where we really see a difference in tone between Chair Powell, what we heard last week from ECB's Christine Lagarde, and all of the other ECB members who've come out and said, we still have a serious problem in inflation. And the fact that inflation data came in hotter than expected yesterday from the United Kingdom really gives them a very difficult decision today at 8 a.m. Eastern when they take a look at how much do they have to raise further to really curtail that momentum at a time when other areas are seeing some sort of disinflation.
That decision about 90 minutes away. Allow me to frame the different views around the Federal Reserve going forward from here. Morgan Stanley see and expect a final 25 basis point hike at the May meeting. They say it's going to be driven by another strong payroll print, sticky inflation, all of that good stuff, or bad stuff, however which way you see it. Needless to say, a surge in bank funding pressures could alter that view. That's the Morgan Stanley view. This is Neil Dutter of Renmac. When uncertainty is high, policymakers enter wait-and-see mode. We only get one jobs number between now and May. He says it's unlikely that's enough information to decide. I think this is the problem we have now. The totality of the data and this data dependence nonsense that we talk about all the time, dependent on what data? Now, I've joked over the last week, does it include bank stocks? But seriously, now the Federal Reserve has told you that financial instability is a substitute for rate hikes. To what extent, no one knows. They don't know either, and they've admitted that. What does that mean for CPI when it comes in, for payrolls when it comes in, on how we should adjust to these numbers if this issue is still ongoing?
Just don't mention it and it won't really be relevant. I think that, honestly, I think that when you look at some of the analyses, they're saying there's going to be disinflation because you're going to get credit tightening. So this data all doesn't matter because it's all backward looking. How many more do we need to see before it matters again, before you start thinking about the other side of this? What's the risk, the binary risk of seeing the inflation potential over the longer term is suddenly surging upward because of a lack of conviction of we're going hard now?
I think the Fed's essentially put a number on this. Anyway, I do believe that because I said yesterday, if we had the SCP 2 weeks ago, that median dot for 23 was coming up 50 basis points. That was my thought at the time. I think everyone shared that belief to some extent. You'd go from 5.1 to 550. Yep. They were basically telling us they might have to lift the median dot. They might have to do more. Kashkari was running around saying 540. So I think we can all agree on that. The fact it stayed the same is them basically telling you, even though CPI was hot, payrolls were decent, that we are going to say, I think maybe 50 basis points of tightening is coming from this financial instability. Okay, when are you going to find out if that's true or not? Is a month long enough for you? Do you need 2? Do you need 3? Do you find that out by early May to make a call on what you need to do with monetary policy? The Fed's found themselves in a really, really tough spot, I think, when it comes to the next move.
And I would take it a step further. If they do wait a couple meetings, then what is the potential damage if they hike rates again, say come September, at a time when people are actually starting to see the effects take hold much more significantly, but inflation just hasn't come down enough?
Here's the Frances Donald take over at Manulife. Here's the quote from her. While the terminal rate is now more in line, the path for the rest of 23 and into 25 is substantially different. While Powell said that the base case did not include cuts, the market's base case certainly does. Who's right? Frances Donald joins us now. Frances, do you think they're done? And welcome to the show.
They might be done. Who knows? It could be another 25 basis points or nothing. But in the grand scheme of things, I don't think it really matters. The market already has a coin toss for this next meeting. What matters and what actually shocks my economic and inflation models is not another 25 basis points or not. It's how fast they cut and when they start cutting. So the conversation is going to have to shift, I think, in the next few weeks away from this next incremental meeting towards what does the path to the next 1 to 2 years look like? Because if the Fed is going to get its way, there's a significant mispricing. I suspect that the market is probably going to have to price in more cuts moving forward, and the Fed is going to follow.
What drives that? The economic data or further financial instability?
The two, and this was the big difference, Lisa. You talked about the difference between the ECB and the Fed. The ECB, President Lagarde told us there is no tension between the price stability and financial stability mandate. And even though Chair Powell implied the banking system is sound, he also was very clear that they were incorporating real economic impact from the banking stress through the lending channel. So we know that this is going to dampen growth moving forward. And indeed, anyone with an economic model, the day that we saw the first initial banking stress, clued in this is going to be a credit crunch. And we have a playbook for that. It's not good. It leads to recessions. It has every single time.
Frances, we've heard from executive after executive, this is not a credit crunch. This isn't a credit problem. This is simply a liquidity mismatch. How do you say to them, you're wrong, this is going to become a credit problem, as it always has with liquidity issues, versus, no, you're right, this is something that could be addressed with deposit insurance or other measures?
I just pull out my charts from before the banking stress issues, in which we already saw senior loan officers telling us that we were in a sizable tightening. This was happening before we experienced banking stress. So even if you want to say the impact is nil, I could still prove to you that we are actually seeing a wide range of data saying that credit is pulling back. And that's particularly important because the bull case for the U.S. economy has been the consumer is strong, and the consumer was being driven by re-leveraging. If that slows or stalls, then we have a momentum slowing. Is that Q1, Q2? Probably not. But our traditional leads and lags tell us that by Q4 of this year, we're in a significant soft patch. So my issue is, well, maybe the Fed goes 25 basis points or not. I think not at this juncture. But how quickly do they choose to respond? And it's possible that the hawkish take here is not the next meeting, but that they try to stay on pause as long as possible, given inflation in this soft patch is probably still a little uncomfortably high.
From what I'm hearing, Frances, it seems like the threshold has gone way down for cutting rates, at least what you expect in the upcoming months. How low do you expect the Fed to be able to cut rates, given that there is a disinflationary effect from some sort of credit contraction?
Well, that's right. We have playbooks for uncertainty shocks, which the banking system stress is. We have playbooks for credit crunches, but it's been a very long time, Lisa, since we had a playbook for low growth, but inflation still around 3 to 4%. The most important thing I heard from Chair Powell yesterday was actually his reference to long-term inflation expectations being anchored. And he said it was true for households, businesses, forecasters and markets. And that may be the direction that Chair Powell and the Fed chooses to tilt towards, as we still see some cyclically high inflation. So even if they come to the end of the year and we have 3 to 4%, they may be able to say, listen, the long run concerns about inflation expectations becoming de-anchored, we no longer have those. We can tilt back towards the employment side of our mandate, because let's remember the Fed does have a dual mandate. We just haven't talked about the employment side in a very long time.
John and I were talking about this earlier, Francis. Do you think that rate cuts in this framework are going to be bullish, are going to be positive for risk assets?
Well, traditionally, the context around rate cuts matters, but we got to get through a recession first. I mean, there is a little bit of something we're seeing now where people are saying, well, the leading indicators of the leading indicators of the leading indicators are positive. But that's jumping the gun a bit. We still have to go through a re-rating of this economy to a lower growth environment, which means lower earnings growth, less activity, an employment shock, maybe jumping the gun just a bit more or a bit too much if we get too bullish on rate cuts at this juncture, given the context.
Hey, Francis, thank you. As always, Francis Donald there, just brilliant over at Manulife Investment Management. A lot of people said President Lagarde did a good job. A lot of people said Chairman Powell did a good job. They did two very different jobs when you compare and contrast.
Jay Powell came out and basically opened up the door to the market retaining its view that perhaps it was done with the rate hiking cycle. That is effectively what they did by keeping the dot where it was and by talking about what was it? There could be a firming.
Additional policy firming. Instead
firming.
of ongoing increases anticipated.
How many people do you think Googled what firming meant yesterday? They were like, what are the contours of firming?
I thought that was a pretty elegant way of dealing with a complex issue. And I imagine it took a long, long time to come up with it when they had their board meeting.
Strengthening.
Look, I truly believe they made what they thought was the best decision at the time.
Agreed.
History's going to judge whether it was the optimal decision. And I said this yesterday, you can look like Burns or you can look like Trichet. You back away too soon, inflation rips, you have to come back in, you look foolish. Or you end up hiking into a bigger crisis. So it's too early for me to say that they've made the right decision. I don't know what the right decision actually is. We're going to find out in the next few weeks. And that's what they were up against yesterday, trying to work out whether this truly was the right decision, given what we're up against.
I think they did a great job expressing deep uncertainty and a complete lack of conviction and a sense of what they believe and that other people have their own beliefs. What I find interesting is that the market took this as a resounding endorsement of rate cuts. I mean, basically that is the one takeaway is game on. And as Francis Donald was just talking about, the question now is how far do they go with the rate cuts in this particular cycle if inflation doesn't come down fully?
They didn't hide it. We said, has 2 weeks changed things? It's only been 2 weeks. They've told us that they think 2 weeks has changed things, that ultimately this will lead to tighter lending standards, that this is a substitute for rate hikes. To what extent, we don't know, but that's the direction of travel for them. I said yesterday, is this disinflationary, this shock in America? They've basically told us they think it is.
And to be fair, a lot of people agree with them, right? I mean, they were reflecting what I would say is the consensus right now, that things have changed in the past 2 weeks. And even if there is stability in the financial system, there will be some sort of restriction of credit. Money is more expensive for some of these regional lenders that really punch above their weight when it comes to credit lending.
Do you want to talk about streaming and sports? Just briefly, you'll often hear me complain about not being able to find the football games in the United States because there are 20 different streaming platforms, each with...
Yes, I've heard them.
Each with a home. You know, Peacock for the Premier League on the weekend, Paramount for the Champions League stuff. I've got no idea where any of it is. Might be coming to a home near you in the UK. Apple is considering bidding for the streaming rights to a range of English football games, according to people familiar with the situation, a move that would step up its sports ambitions and increase competition with Amazon and Prime Video. This coming from Giles Turner here at Bloomberg this morning.
I love your hot take. So basically you over in England, you're not escaping the,
I believe BT Sport, I think Sky Sports, I think Amazon has had a little dabble as well. So, you know, I don't care who hosts it. I really don't. I just want to know where to go for certain games.
Why couldn't it just be a menu? You know, you like
I don't know.
Football.
I don't want to exit one app, find another app, and exit one app and find another app.
Someone right now is crafting a solution just for you.
I hope they do. Not just for me, but for everybody. Futures on the S&P, positive 0.25% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Worries over inflation trumped the recent banking turmoil as Fed Chair Jerome Powell rejected the idea of rate cuts and said that more tightening may be ahead. Wednesday's quarter-point rate hike comes less than 2 weeks after the second biggest bank failure in U.S. history. The Swiss National Bank raised its interest rates by 50 basis points and indicated that there's more to come. The SNB signaled that inflation outweighs any concerns after the market reaction to the downfall of Credit Suisse. Meanwhile, SNB Chairman Thomas Jordan says that Swiss banks are not exposed to U.S. bank failures. Top executives at First Republic Bank have agreed to forego their bonuses for 2023 and some other pay. The bank has lost more than 88% in market value this year, and it's grappling with a crisis in confidence in some regional banks. Washington and the banking industry have been trying to keep First Republic from becoming the next bank to collapse. It's a victory for Boeing in Japan, the nation's flagship carrier, Japan Airlines. It's agreed to buy 21 737 MAX jets. Airbus was originally seen as the front-runner for the sale of the 320 Neo aircraft. The Boeing order is estimated to be worth about $1 billion. And there's a late twist to the sale of world-famous football club Manchester United. Bloomberg's learned that bidders have been granted extra time to come up with new offers. A Qatari consortium has already raised its offer above its initial $5.5 billion bid. British billionaire Jim Ratcliffe's first bid was below that. I'm Lisa Mateo. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The government does recognise that there is some volatility in the market, but we believe the UK financial system is fundamentally strong and UK banks are well capitalised. They now have core capital ratios that are 3 times higher than before the 2008 global financial crisis, but we continue to monitor the situation carefully.
Jeremy Hunt there of the UK, the Chancellor of the Exchequer on the banking system in the United Kingdom. It seems to me, Lisa, if you're a finance minister, a treasury secretary, a chancellor, you've got to come out at the moment and say how strong your banking system is. That's never good.
That's not a good thing, especially when it's literally all over the world. You can see every central bank with the obligatory, our banking system is sound. We are not the United States. Read between the lines. We don't have a regional banking crisis.
We are well capitalised and all of the above. The problem for the UK this week hasn't come from the financial system. It's come from the data. Inflation back to double digits. And I think this is the problem of a central bank trying to back away from rate hikes. Lisa, you're confronted with the economic data again, and they got slapped around the face by CPI at 10.4%.
And this is the reason why really the theme of the moment is how much divergence does there have to be from central banks that are dealing with inflation that in some places has peaked out, in other places really hasn't. And there really are a sense of differences between the different inflationary drivers in, say, the United Kingdom versus the US.
Looking for a move to 4.25 today from 4%, looking for a 25 basis point hike from the Bank of England. Joining us now is Jennifer McKee, Keown, the chief global economist at Capital Economics and the former BOE economist as well. Jennifer, thanks for being with us. Let's start here. The best decision today, what is it?
Oh, difficult one. I think it probably is best to press on with another 25 basis point hike, just particularly given those inflation data that we saw yesterday. The strength of food inflation and the effects of that's having on services inflation in the UK are a particular concern. But I think it's a much closer call than the market seems to think, than market pricing seems to imply at the moment. It's worth remembering that its last meeting, which actually seems a very long time ago now, but at the start of February, that the Bank of England was the clearest of the major central banks in indicating that it was close to the end of its tightening cycle, that further tightening would depend on the data being stronger than it had expected, either on the inflation or activity front. So I think it is a fairly close call.
Do you think that even if they do hike by 25 basis points, Jennifer, that they will indicate, sort of as Fed Chair Jay Powell did, at least this is how he was read in the markets, that they are now at the end of the rate hiking cycle, and now it's just a matter of when they start cutting?
Yeah, I think it will be a fairly dovish tone, pretty similar to the one that we've seen from the Fed. Actually, the Bank of England is a bit different in that quite a few of its rate hikes have been on the relatively dovish side, and I don't think this one will be any different to that. There are clearly big risks to the economy in the UK, and those have intensified with the turmoil in the banking sector. There's got to be a good chance that credit conditions tighten much more aggressively in the months ahead. The Bank of England will very much have an eye on that and the possible implications for inflation in future. A lot of the commentary is trying to separate the two things, and for now I think central banks are trying to do that too and say, look, we're still serious about the inflation fight, we're going to continue raising interest rates, but ultimately in the future, if credit conditions tighten, then that brings down inflation too. So these two goals become aligned at some point.
Jennifer, every single central banker has tried to draw a distinction between their banking system and the one in the U.S., their banking system and how it is much more secure than, say, those that could be subject to deposit outflows. What about in the United Kingdom, where there is a unique set of issues, particularly how tied to interest rates some of the mortgages and other debt really are, where they adjust in real time?
Yeah, well, it's right about the banking system that it's very well capitalised, but that doesn't really help you if there are massive deposit outflows. It doesn't matter what bank you are or how strong your position is. If your deposits leave, then you're in trouble. What we've got to hope is that the fact that capital ratios are relatively high, that the banks appear to be in good health, will prevent that loss of confidence that would lead deposits to leave. Yes, the UK real economy is relatively exposed to what's happening to interest rates. The feed through should be relatively rapid, but there has been quite a shift in the UK from the variable rate mortgages on which we used to rely very strongly, unlike the US, towards a bit more of fixed rates and longer term rates. So that pass through isn't quite as quick as it was, but that's a good thing and a bad thing. In some sense, that just makes you think that even more of the drag from the policy tightening that we've already seen is yet to come, as it does start to feed through to the real economy. So that's just another reason, really, for the Bank of England to act with caution.
In fixed income, we'd call it a maturity wall. You know all this stuff, Jennifer. In high yield, we'd say, when does everyone have to face that moment where they have to go out there and issue debt because other things are maturing? Jennifer, is there that cliff edge moment with fixed rate mortgages? Is it a 2 year, 3, 5? What's the average one in the UK? Where is that moment?
Yeah, I think it's around 2 years now, but where that moment is extremely difficult to judge, unless you know when everybody's mortgage is maturing and when they might decide to remortgage for reasons of their own. But our sense, having dug through the data, is that probably only around a third of the impact of policy tightening has already come, and there's probably another 2/3 to go if we assume that we get another hike today, and also that the effects of the previous policy tightening are feeding through.
This goes to the long and variable lags question. Are they longer, shorter in the UK versus, say, the United States versus Europe? How do you think about that issue?
Yeah, I think they're probably still shorter in the UK than they are in the US, partly because of the fact that the kind of very long-term fixes on mortgages are not so common. But it's massively uncertain. The other thing about these lags is that we know that they're variable, they're quite long, but also they're very, very unclear. So central banks are very much reliant on watching the data and watching what's going on, not just in the real economy and inflation, but also in financial markets and in the banking sector, to judge just what the effects of their previous tightening have been. And I think the banking turmoil that we're seeing now is a clear indication of some of the effects of this past policy tightening, even though it was difficult to pinpoint in advance just how it would play out.
Jennifer, I think a lot of people would agree with you that the lags are shorter in the United Kingdom simply because of the structure of a lot of the debt. So is there a warning in that for what the potential ramifications for inflation could be, especially given the fact that we just saw an upside surprise in inflation in the United Kingdom, even after all of the hikes that have been implemented? Yes, there's a warning in it, and the bank's going to need to act with caution. And I think that's probably one reason why, although in terms of the inflation data, it was clearer that inflation was turning down in the US, 6 weeks ago at the time of the bank's last meetings. And yet the Bank of England was the one that said more clearly that it was reaching the end of its tightening cycle and that the coming moves would be very data dependent. So I think that's probably a reflection of this to some extent, the fact that the pass-through is relatively rapid. The economy is quite reliant on the banking sector too.
Jennifer, thanks for the insight. Jennifer McKeown there of Capital Economics, about an hour and 6 minutes away from that Bank of England rate decision. The UK gets so much attention. Why aren't we talking about France? Have you seen that mess playing out in Paris at the moment?
With all the strikes?
Unbelievable. Forcing through a lift, raising the retirement age from 62 to 64. I was just looking at some of the news around French airports. One airport in Paris, the Civil Aviation Authority asking the airlines to cut flights by 30%. By 30%.
And if you take a look at the cost of hotels, I feel like I'm sitting in Tom's seat, so I have to mention the cost of hotels in Paris. But, everything is getting more expensive because there are fewer workers and there's fewer availability at a time when they kind of need the tourism and they need some of that to keep the growth going. There is a question of why you're seeing so many more with strikes, so much more labor upheaval, what this means for wages, what this means for the stickiness of inflation at a time when perhaps, yes, it's being transmitted through monetary policy, but there are structural forces underneath the economy that we can't forget about that are prompting increases across the board in wages and in prices.
Well, I think actually it's the model, the French model, the socialist model, that right now, given what we're facing in this economy, they've got to make clear changes, and that's why it was forced through by Macron.
And the reason why I think people talk about the UK right now in tandem with this type of situation is because you're seeing strikes in the UK that you hadn't traditionally seen, that are more akin to what you would see in France. You disagree?
No, I'm just saying, we still pick up the trash. London.
So you're not going to go to
London's
Paris with heaps of
London's
trash?
pretty tidy. It's clean.
What do you feel at New York City?
New York? It's pretty tidy. It's clean.
Do you really feel that?
It's pretty tidy. It's clean.
It depends.
What would you like me to say?
Hey, can I tell you something?
Have you got different thoughts on New York?
Yeah, it waves. During the pandemic,
Waves.
it was
Nice.
a problem. And,
well done.
Anyway, moving on. I do want to just say this. I was looking at synonyms for the word firming because I wonder if that's what the Federal Reserve did. Is they basically were like, okay, crystallize, amalgamate, coagulate. Like, how do you sort of signal?
They sit there and do that.
You think so?
Yeah, I'm told. They do.
On the Bloomberg?
No, I'm told.
Really?
Not on the Bloomberg. They have a Bloomberg.
But you think that they actually
They go
look up
through words. Oh,
synonyms?
totally. Totally. Sit around the table, work it
Congeal?
out. Yeah, spend ages doing this.
We're gonna
Talk
have-
to Clara about it.
That's really
Yeah,
cool.
no, spend ages.
I would enjoy that. Gel.
Gel. Is that another word?
Yeah.
Okay, cool. This is a good show. It's really good.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I texted Tom yesterday, said dovish hike, lost it, went nuts. I'm so pleased he's not here because he'd be going insane as we talk about this.
That's exactly what they just did. It's a dovish hike.
It's a dovish hike, 25 basis points. Enjoy the beach, Tom. From New York City this morning. Good morning, good morning. Equity futures right now, positive 0.4%, alongside Lisa Abramowitz. I'm Jonathan Farrow, TK out all week. He's going to be back on Monday. Lisa, it was a dovish hike. It was 25, and quite clearly, I think they were pretty clear about the whole thing, that they believe the financial instability is a substitute for further tightening.
Facts have changed, and so did their expectations in terms of their rate path. At least that was how the market interpreted it. And I do think that while they did push back against rate cuts, it seemed like the balance of risks shifted downward. Basically, the chance of a hard landing seemed more clear in terms of what was happening with the banks, and rate cuts are now priced into the market pretty solidly.
Neil Dusser, Renmark, asking the right question, I think. There's not much time between now and the May meeting. It's early May, first couple of days of the month. Is that enough time to get enough incoming information to make a decision either way about hiking interest rates or not? I think you wait and see, don't you? Which is why some people think maybe a pause in May, regardless of how this plays out through the rest of this year.
Yeah, I'm not willing to even go that far, because ultimately, if we don't see any banks collapse and if we see some sort of stability, let's say we get to deposit insurance. Let's say today Janet Yellen goes to the House and says, you know what, we're going to insure all deposits to up to $4 million and, you know, game on. Do they then go back and say, okay, well, our preeminent concern still now is inflation at a time where the banking system seems pretty safe and sound?
You'll be talking about no landing again.
Exactly.
And keep going back to it. It's only been 2 weeks. It's only been 2 weeks. But their base case has changed. Their base case has changed.
The difficulty for investors right now, I think Jeff Rosenberg yesterday put it really well, where he was talking about the asymmetry of risks and how the tail risks are getting so much wider, where you could end up getting either much higher inflation on the back end, or you could get a hard landing and rates going to 1% or 2%. So either way, you could have a very different picture and a very different investing thesis.
Jeff was right to point that out, and I think the phrase was something like, the risk cuts both ways. And the risk truly does cut both ways, which is why I thought it was pretty hard for the Fed to make what might be the right or wrong call. 25 basis points, wait and see is the right call. Wait and see how this plays out, because both of us have got no idea how this plays out in the next couple of weeks.
I do just keep going back to Janet Yellen, though, and what she was talking about in front of the Senate committee that she was speaking to, about how we haven't even considered insuring all deposits, which seemed to run counter everything everyone was saying at the same time that Jay Powell was saying the banking system is safe and your deposits are safe. So how do they square that at a time when people are depending on some sort of resolution there as one of the linchpins for the economy to have a soft landing or just cool more gradually?
So I'll make this point repeatedly through the morning, so forgive me if you've heard it before. I'll make 2 points. One, I don't think she contradicted herself from earlier in the week. I really don't. I really don't. I think there's a massive difference between saying, if a bank poses systemic risk and there could be contagion, then we will use the systemic risk exception to make all depositors whole. That's 1 point. There's a big difference between that and then saying we're going to have blanket deposit insurance. Massive difference. You can drive a truck through those two things. There's no nuance there. That's a huge, huge difference. What surprised me yesterday about Yellen's comments, it's not that she somehow contradicted herself from the day before. It's just the idea that they hadn't even discussed it. That's what I don't understand. Are you telling me after 2 weeks of this, after seeing deposits flee, banks in trouble, that the Treasury, they hadn't even had a discussion about blanket deposit insurance? Are we serious?
This does seem to be a little misstep or oversight. There is also, though, this question of how do they push back against a market that has gained some solace from the idea of deposit insurance in a broader sense to solve the problem, because right now people are saying a Band-Aid with just sort of swooping in and miraculously saving any bank that runs into issues isn't going to solve the problem over the long term at a time when there is a just completely different backdrop for the speed of which deposits can leave a bank.
We've got a lot to work through. In about 55 minutes, you're going to have a Bank of England rate decision, looking for a hike there as well of 25 basis points. They're very focused on the incoming information too, like everyone else. CPI early this week in the UK, north of 10%. Lisa will go through the day ahead in just a moment. I'll whip through the price action. We are positive by about 0.5% on the S&P 500. In the bond market, big rally into the front end yesterday. Yields lower by 20 basis points, even after that rate hike. Given that the median dot for 2023, the projections of the Fed remain basically the same when it came to the dot plot for this year, at least. A lot to talk about elsewhere. Your 10-year higher this morning by 5 basis points, 348. Lisa, 348.84.
You mentioned that the Bank of England is having a press conference today. The rate decision comes out at 8 a.m. We're going to be hearing from the Bank of England's Catherine Mann. She's speaking at 11 a.m. And I'm curious about this divergence. We've been talking about it all morning, and we will continue doing it. Are we seeing a material shift from the U.S. more on hold and other European nations in particular, continuing with some rate hikes and more uncertainty as to the path ahead, with an eye toward perhaps further hiking? 10 a.m., TikTok CEO Shu Chu is testifying before the House Energy and Commerce Committee. Very interesting to see whether we get some indication of the willingness of Congress members to potentially ban TikTok, force a sale, do something to insulate some of the data concerns that people have raised. And at 3 p.m., we get a Janet Yellen redux. She is heading back to testify in front of the House Appropriations Committee. Does she clarify her comments? Does she give some sense of what the discussions have been, where she and Jay Powell are on the same page, what the indications are for how they are going to solve a problem that has caused the KBW Bank Index to absolutely crater over the past couple of months?
She can say deposits are safe. She can say that. She can say she thinks they are. She thinks the financial system is resilient. It's basically what the chairman said yesterday in the Fed news conference. The one we all want to know is whether they'll drive forward with blanket deposit insurance. And when she's asked about the policy, she can't square the circle. That's the spotlight right now. That's the point of tension for this Treasury Secretary. Got some information for you, some breaking news. It comes from Ford, the motor company, predicting losses in its electric vehicle business will grow to $3 billion this year. Let's frame the $3 billion this year. The deficit would match its accumulated EV losses over the past 2 years. this story coming out just moments ago. Lisa, the transition to EV, expensive, really expensive, and Ford's putting a number on it this morning.
Especially because at this point, people are still buying trucks that are fueled by gasoline. And so how do you end up switching to a more modern technology or something that's the future when you don't have the clientele yet to back it up? And the transition costs are expensive.
I think the order book for some of these vehicles, though, pretty big, isn't it?
I would agree, but the costs incurred by outfitting your whole factory is
difficult.
Is a big thing.
It's not an overnight thing. You saw the struggles that Tesla had, and they didn't have that legacy business to transition from. This is really difficult stuff. So that's the latest from Ford, predicting losses in its EV unit, the business to grow to $3 billion this year. The deficit matching has accumulated EV losses over the past 2 years. Joining us now is Jose Rasco, the CIO at HSBC Private Banking and Wealth Management in the Americas. Jose, let's start here. I've asked this question a few times. Is the Fed done from what you've heard yesterday? Because this market is screaming, you are so done.
You know, we don't think they are. I mean, if you look at what the Fed has said, they said they want to keep going, and we're going to keep to those words. We think they're going to go in May and June and get us to 550. And then we think they're going to be on hold for a while. Our economist has them on hold for the better part of a year. Now, that's going to come under fire, obviously, because, you know, the economy is going to weaken, and we're going to see what happens with the fragility of the banking system. That could change that course of action.
How much confidence, Jose, do you have in that view, given the fact that right now that goes completely against where the market is?
Yeah, well, we've got them cutting rates, but not till next year, right? So that's the problem, I think. And I think, Lisa, you raise a key point there. The Fed's trying to walk a fine line here, right? They're trying to tighten on the one hand, and tighten conditions are tightening in terms of financial conditions. But on the other side, they're trying to provide the liquidity that the banking system needs. And liquidity seems to be the key word. So it is a fine line they're walking. And I think, you know, the market has anticipated a lot of rate cuts this year, but our economist still thinks it's off in the future. Yeah.
Is the investing proposal pretty much the same, regardless of whether there is a banking stress that causes the Fed to cut rates, or if the Fed doesn't see that kind of distress and continues with rate hikes and then holds for a year? Is it the same kind of outcome when it comes to where you want to put your money?
No, not at all. And I think, you know, the first thing we have to get our hands around, or our arms around, is what happens in the banking system in the short term. You talked before you put me on here, talking about regional banks and what's going to happen there. And a good deal of money has left, right? And as a result, they're going to have to do something to attract that capital back. And therefore, we're looking for downward revisions to earnings in technology because of the obvious situation with SVB and the banking system and financials. So, we're looking for more downward revisions to earnings there.
Well, Jose, given everything that's happened, and I've got to put you on the spot, you've got to put money to work, are these regionals investable without blanket deposit insurance at the moment?
That's a great question. I think, you know, I think what they've said implicitly by not saying, and I've heard the argument, you know, is that they will insure banks that are in trouble. And I don't think that's going to work. You're going to have to step up to the plate and either make a commitment or not make a commitment. And what they seem to be doing is piecemeal. And therefore, the market may push their hands and may force them to the table to make a commitment one way or another.
So is that yes? They are uninvestable for now, Jose?
Well, no, right. I mean, we're selective, put it that way. You know, I think right now, yeah, we're telling most clients that, you know, stay away from the regional banks now because we think there's more downside. But yes, we think there is some room in the future. But for now, yeah, we're very selective.
Interesting. Jose, thanks for that. Jose Rasco there of HSBC. Lisa, difficult moment, isn't it?
Especially
to make that call into those banks.
We're not getting any certainty on policy.
Zero.
None. And so how do you even begin to come up with a base case of profitability if you don't know what the parameters are?
What are the parameters? What are the parameters right now? How wide is the band of outcomes right now for 2023?
It's about as wide as you could possibly get. You could either get some sort of deposit backstop that gives a real boost to these banks, and all of a sudden they become the profit engines that they once were, or you could end up with more regulation and concerns about deposit flight. So then what do you do with that?
Let's say DeLongis is going to join us shortly. He came into the year constructive on risk assets. Then he got into the month of March and he became less constructive on risk assets. We'll talk to him about that. Alessio DeLongis of Invesco coming up very shortly. Equities up 0.5%, yields up too by 6 basis points, just short of 350 on a US 10-year in America, 349.41, a Bank of England rate decision about 50 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fed Chair Jerome Powell has made it clear that inflation is still the top concern of the central bank. Less than 2 weeks after the second biggest bank failure in U.S. history, Powell advised that more Fed tightening may be in store following Wednesday's quarter-point rate hike. Officials are betting that the bank turmoil won't turn into a broader financial meltdown. The Bank of England is likely to continue the quickest set of interest rate increases in 3 decades. Investors and economists expect the BOE to raise the benchmark lending rate by a quarter point. Those expectations were solidified on Wednesday when new data showed inflation climbing in the UK for the first time in 4 months. Treasury Secretary Janet Yellen says the U.S. is not considering blanket bank deposit insurance without working with Congress. A Senate subcommittee had asked Yellen whether protections for all U.S. deposits would require congressional approval. She also said that the heads of recently failed American banks should be held accountable. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals, which the U.S. has rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. And Ford's transition to electric vehicles isn't cheap. The automaker predicts losses in its EV business will grow to $3 billion in 2023 as it spends big on new models and factories. That matches its accumulated EV losses over the last 2 years. Ford has now started reporting financial results by business unit rather than by region. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021, and now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
They're happy to export something here that 150 million Americans are consuming 3 weeks a year, you know, on a platform that's run by the CCP that may serve their interests in hoovering up data from the American people. I think the American people have the imagination, if we chose to to choose a different platform, and I think that's what we should do.
That was Senator Michael Bennet of Colorado on Balance of Power on Wednesday, talking about TikTok. The CEO of TikTok looking to defend the company on Capitol Hill later today, saying in prepared remarks the following: TikTok has never shared or received a request to share US user data with the Chinese government, nor would TikTok honor such a request if one were ever made. Lisa, is that sufficient?
No, because right now there is a narrative in the market, and that's what's going to be perpetuated by a lot of the politicians who are going to be speaking with the TikTok executive. What I think is wonderful about covering markets is it gets to the nuts and bolts of who benefits for when they do sell this immediately. It goes to, okay, well then on the other side, what happens if they sell these assets? Snap shares up almost 2.5% in pre-market trading just on cue ahead of this hearing.
And they've been flying.
They've been flying.
This is what Snap wants, is what Facebook wants, because they can't get exposure to the Chinese mainland. And their view is, look, it's not just about TikTok and whatever you think about TikTok, it's about reciprocity as well. Surely that's the belief of these US social media companies.
I'm sure that belief is also informed by the fact that TikTok has the eyeballs of more than 3/4 of all teenagers in the United States.
Amazing numbers, isn't it?
Shocking numbers. So if they could take over that business, then ka-ching, right? So this is really the underpinning of some of the lobbying efforts that are behind the scenes with this particular hearing.
Always the way. Anne-Marie joins us now down from Washington, D.C. AMH, how tense do you think this hearing's going to be?
It's going to be incredibly tense, and it's going to be hours long. These lawmakers have been preparing on what and how they're going to tackle their questioning to the CEO, Shu Chu, and it's going to come from everything in cybersecurity, national security, as well as to mental health. And you do have some lawmakers who are going to point to suicides that have happened with young teens, saying that they got these ideas circulating on TikTok. So there's going to be a range of issues at play here, and really he's going to have no allies in the room. This is a lose-lose hearing for this CEO. What he has been doing is try to fight some of this before he goes into that room and gets grilled by lawmakers. He came out with his own TikTok and said, if you want to make sure you can keep this app for all your content, to his 1.5 million Americans that are on it, put your appeals in the comments, and also call your elected officials. And what you're seeing in Congress over the past 24 hours is actually the youth in the rotundas creating TikTok videos. They're there in support of the CEO.
How do you prepare, John, for a lose-lose hearing? If you know you're heading into the firing squad where everyone's just going to hate you, how do you prepare for that?
Look, if it's about security and national security, that's it. Bottom line, it's over. It should be conversation over. Shouldn't be about pleasing a certain part of the electorate because they use an app that you might ban.
Well, and this raises a question, and Anne-Marie, weigh in on this. Why haven't they banned this if CFIUS even recommended either a sale or some sort of ban?
Okay, so this has been through CFIUS prior to the Biden administration as well. During the Trump administration, Trump had an executive order that wanted to outright ban the app, but it got struck down in the courts. There's been a slew of legal challenges on that executive order. Then the Biden administration comes in, they had to redo that executive order, set up CFIUS again. That is why you have this issue we have today. It really got hobbled up in the court structure. Congress is the one that needs to move and give the authority to the executive branch to make a move on TikTok. Right now, I know you guys will be speaking to Senator Mark Warner in the next hour. It's his bill in the Senate that has the White House backing. That will give the Commerce Department to look into items like TikTok, not just TikTok. They want to give it broad support. What is interesting about this will obviously take months. They need to make sure the House gets on board as well to then send it to the president. And then once it goes to Commerce, then Commerce needs to do their review. This is going to come very close to the 2024 presidential election, when Democrats certainly need those young eyeballs on TikTok. That's where they get their news, and these individuals lean liberal and likely would be voting for a Democratic president.
That's where I was going to go, Anne-Marie. I've been making light of the fact that this is sort of the footloose of the modern generation, that basically people, teens and other young people who are on TikTok are saying, let me do my dances, let me get my news this way. What's the problem? Is that really the main pushback to why this hasn't really been a more actionable item yet?
That's one, I think, pushback that everyone is well aware of, that this would annoy the youth of their constituents. Senator Bennett said he's not on TikTok, but, you know, don't tell my kids I'm not, because all these individuals either have kids, no kids, and this is where they spend their time. This is how they socialize. But I think that's only one part of it. Obviously, they want to wait for the full CFIUS review. We've had reporting last week that that's pretty much hit a wall, with CFIUS recommending you either have to divest, sell. This can no longer be as is, status quo in the United States. So I think now you're going to really start to see this momentum pick up after we've seen the CFIUS review really hit a wall. TikTok thought they can get around it with Project Texas. They say that Project Texas is unprecedented, but I spoke to a source that said unprecedented doesn't mean it's sufficient when it comes to user data.
MH, great work as always. Looking forward to your coverage later. Anne-Marie down in Washington. You can catch Anne-Marie and Joe Matthew on Balance of Power on Bloomberg TV and on Bloomberg Radio. You can see this weekdays at 5 p.m. Eastern Time. Balance of Power coming up a little bit later. Lisa, looking forward to their coverage, and I'm looking forward to this hearing as well. This is one of those hearings, and I think most hearings are this way, where they've already made up their mind about the outcome of this hearing. This is just kind of like entertaining the other person on the other side of the room. And we'll catch up with one of the senators leading this effort in the next hour, and we'll ask him just about that.
I want to hear how much is about national security and how much is about, you know, the mental health of individuals and things of that nature, because that's got to get Snap and
Well, if it's mental health, it's all of them, right?
A little nervous. I mean, that's not just a, you know, victory for them, and you've seen that victory in their shares, but you start to put restrictions on some of the big social media companies. You start going after some of these other issues. They're pretty broad-based. This is not just isolated to TikTok.
We mentioned this earlier. This is a hangover from the previous administration. What was the deal? Oracle and Microsoft, it was some random tie-up where TikTok was going to have a sales force through, and here we are years later talking about the same thing. Now, what's this bill about today? Handing off authority to the administration to make the ultimate call. Where's the administration on all of this?
The administration has come out, I believe, and said that they backed some sort of action on this particular company, and either a sale or a ban. How it looks, what their actions are going to be, whether they're open to it, the nuances. I'm sure you can drive a truck to it just through, like Janet Yellen and her comments about bank deposits. But, you know, will they? Especially ahead of the election. And I think that Anne-Marie framed that well. If we're bumping up against the election and you have young eyeballs on a site that gets, you know, lots of advertising from said politicians, are you going to really ban it at that moment?
That's a double-edged sword. And this is the problem the CEO's got today. When he comes out and says, we're on 150 million phones, you've got to think that through a little bit more. I mean, on the one hand, that says people like our product. On the other hand, we've got access to 150 million phones. That's not what this hearing wants to hear.
Correct. But then they think, but you're on 150 million phones. I mean, this is sort of the conundrum of politicians, because that's access, right? And this is sort of
shouldn't be a conundrum.
How do you really feel?
It shouldn't be.
Well,
it's not for me to say it's a national security risk. They've got to make their mind up about that. I'm just here saying, if it is a national security risk, it's proven to be a national security risk. The rest of this shouldn't even matter, should be done. Forget about it. But the fact we're even entertaining this conversation that the youth won't come out and vote if you ban TikTok, we're meant to accept that something might be a national security risk, but because those individuals might go out and vote in the next election, we should just allow that?
Well, how much, I'll take that a little bit broader. How much is that really an argument about social media in a broader sense, with a lot of social media having a lot of the ills that Anne-Marie was talking about and proven out to be, and yet it's access. So advertisers, politicians, everyone loves it.
Sure.
So how much has been the double-edged sword more broadly that has ended a lot of very important conversations that people have had?
Like we've said, it's been going on for a long time now. Yes, it's not a new conversation. Winnie Caesar's going to join us shortly. Looking forward to that. And we'll catch up with an interview Francine Lacroix has done with the SNB president. Really important stuff coming up shortly.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
2 hours away from the opening bell, equity futures look like this on the S&P 500, positive by about 0.5%. 30 minutes from now, you get a Bank of England rate decision. We'll break that down with the team over in London. A little bit earlier this morning, we had a great interview with the Swiss National Bank President, Thomas Jordan. They've hiked interest rates. Bit of a messy time over in Switzerland. Take a listen to what the Swiss National Bank President, Thomas Jordan, had to say a little bit earlier this morning.
Basically, the Fed is saying that, one, uncertainty has gone up a lot. We're not really sure how long the banking system stress is going to last and how severe it's going to be. Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier.
That is not the right tape. I'm hoping we have the right tape now, so let's try again. The Swiss National Bank President, Thomas Jordan.
The Credit Suisse problem is much smaller given the fact that UBS will take over Credit Suisse. So this problem is solved, and this is good. So we have a stable banking system in Switzerland. Obviously, we have a certain uncertainty on the global scale. But I think we have to continue to follow that very closely, to observe it very closely, and then see what is the impact on the Swiss situation.
President Jordan, were you surprised by the turmoil that we saw in the markets given the wipeout of AT1s on Monday?
Well, I cannot really comment on the AT1 issue. This is our financial regulator who is in charge. There was some impact, but I see for the Swiss situation, it was limited.
But were you surprised by the market turmoil after the weekend in general?
Well, I cannot really comment on that. We are not in charge of the decision regarding the AT1s.
But of course, if there's market turmoil, it impacts what you're looking at and the parameters. Yeah. Are you confident that we won't see a day like Monday again?
Well, we expect that now the situation will calm down, and also that people look at that very carefully, and it becomes more clearer what exactly are the medium to long-term consequences then.
What do you worry about the most right now? I know that a lot was done over the weekend, and you said, look, all of the other options, we would have been worse off. But going forward, what could be troublesome?
No, I think it's not absolutely essential that both banks, UBS and Credit Suisse, do everything that the takeover takes place in a smooth way, so that we do not have any risk anymore. So the commitment of both is complete. And it's very important that they work closely here together. This is important for their situation. It's important also for Switzerland, and we are supporting that by all necessary liquidity. This is something where we look at very carefully, of course. On the global scale, the uncertainty remains high, and we look at that as well.
So I know you're briefed actually minute by minute, right, by what's going on probably with the two banks. What can you tell us about outflows from Credit Suisse? Is there a danger that actually the financial system in Switzerland has just become less secure, that depositors are wondering what happens also to this large bank?
Well, as you all know, last week was a critical situation, but now with all the measures that were taken and by the decision of UBS to take over Credit Suisse, I think this problem is now solved. and the situation is now much better.
Can you explain, President, what you think happened in the last 6 days? I mean, it all started in the U.S. with SVB. I know there were a number of also contacts, for example, with U.S. Treasury and U.S. regulators.
Yeah, of course, there were contacts. I think that it was a Swiss decision and a decision that was also a private sector decision to do everything that avoids a resolution. Resolution would have been very problematic. It could have triggered a financial crisis in Switzerland with all the negative impact immediately in Switzerland, but of course also globally. So it was very important that we could avoid resolution in those circumstances, given the fragility of the banking system globally and the financial markets. And that was achieved by having this takeover of Credit Suisse by UBS.
But what surprised you the most at the speed? And I know a lot of people are commending you at how fast this went. I mean, this was a fully capitalized bank.
Yeah, that's right. The bank was well capitalized at the beginning of the week, but then we had these shocks coming from the US. And at the end, we had in a very few days really a meltdown of the confidence of both counterparties and deposit holders that created this difficult situation. And fortunately, it was able, also due to good preparation, to have in a few days a solution that then avoided resolution under those circumstances.
Francine Lacqua joins us now from Zurich. Francine, once again, just phenomenal work. Once more, catching up with really important figures over in Switzerland. Francine, what did we learn this morning about the SNB and what they knew over the last week going into this takeover of UBS from Credit Suisse?
Well, what we learned is actually they're very conservative and don't want to say very much at all in terms of the market turmoil, certainly on Monday. I mean, we asked them multiple times, and of course, Thomas Jordan, president of the SNB, also fielded many questions at press conference saying, did you think that wiping out the AT1s would lead to such market turmoil? Like, remember, market turmoil is also in their remit, but he would absolutely not be drawn on that, saying, well, financial regulation, so the decision, AT1 and everything that ensues is actually FINMA, the regulator. What we also learned is that there doesn't seem to be a clear picture. Now, remember, we are only 4 days since that government broker deal between UBS and Credit Suisse, but there's no real picture about what happens next. He was asked also, and we tried to get more information on actually whether this changes supervisory roles, whether this leads to more rules. We also asked, of course, about what Jane Fraser said. Was there a bank run because we're much more on our mobile phones? And he said, look, he doesn't think this is the case at the moment. So this was a Swiss National Bank that was prepared for all questions, but prepared by just not answering them. It's still very soon to understand what the legacy of this cobbled together merger is and actually what kind of big, large bank Switzerland ends up with.
Francine, how much pushback is there within Switzerland, the move of regulators to allow AT1s, to allow these contingent convertible bonds to get wiped out before equity? How much investigation is there as to how that decision got made at a time where people are threatening lawsuits and they're seeing a huge divergence open up in pricing with the Swiss market and the European market?
So, Lisa, good morning. We actually heard from one of the parties looking into this, but I think it's going to be pressure really from outside. And of course, if you wipe out $17 billion worth of AT1s, they're going to be holders of that. So we're hearing about lawsuits. I thought it was very interesting. Remember, we were at that press conference on Sunday when we asked about AT1s. And at the moment, you know, we hadn't had a clear picture of why that happened. It was only 4 days after this morning that FINMA, the regulator, so not the Swiss National Bank, put out this statement really explaining why they did that. But we had about 100 banknotes from various banks, from various analysts explaining why. So they're basically basing themselves on a law and a footnote in the prospectus saying this was the right way to do this. We also know from insiders that this was the big debate on Sunday. Like, if you do this, what does it mean for financial turmoil? So I don't know if the debate is really going to unfold in Switzerland or it's going to be those bondholders that we're trying to get to the bottom of exactly who held what that will try and do lawsuits. So it'll be Switzerland against these international bondholders.
Francine, wonderful work once more. Francine Lacqua out of Zurich. Francine, thank you. For those of you that would like to watch that interview in its entirety, you can find it on the Bloomberg terminal and shortly, I'm sure, on Bloomberg.com. Joining us now is Winnie Caesar, Global Head of Credit Strategy over at Credit Sites. Winnie, you came into this month with a different approach. You were tactically cautious, and now you become more constructive over the last couple of weeks. Winnie, walk me through just the evolution of your thinking just over the last couple of months.
Good morning, Jonathan. Thanks for having me. So you're exactly right. We started the year very constructive on credit, and spreads hit our base case forecast for both U.S. investment grade and high yield by the end of January. And we thought, well, this feels a little overdone. And heading into that week of central bank meetings at the beginning of February, we were a little bit concerned about hawkish messaging and what could happen in the Treasury market. And that really unfolded. And then we had the banks issues. And we also went into this round of volatility fairly cautious on the regional banks. Our financials teams have had a really great call. And as of last Friday, we felt like perhaps things are a little bit overdone. Spreads had really blown out, yields had tanked, and we thought it's time to take that tactical caution off and go back to a full overweight in U.S. credit.
This is fascinating at a time when a lot of people say it's so hard to get any visibility given some necessary regulatory changes, whether it's deposit insurance or whether it's greater regulation on some of the smaller banks. How do you determine from a credit vantage point what's investable, what kind of uncertainty you're willing to accept?
This is a really tricky one, and I think that as we're thinking about the Fed and monetary policy and implications for the broader economy, banks are really where the rubber meets the road in terms of taking financial policy and pushing it into the real economy. So we think a lot of this is going to be a disinflationary type event, which is good. That's what the Fed has been trying to go for. The big question is, how much of that momentum really impacts consumer spending, makes it its way into the labor market? And we don't think that there is a material risk of broad-based challenges. Instead, we've been calling for this bumpy landing. We don't ascribe to a soft landing or the no landing. Instead, some segments of the economy are going to feel some real pain, but we think that there's some pretty good visibility into the corporate credit markets where fundamentals are quite strong and have the ability to withstand some of those headwinds.
How do you push back then against some who look at credit spreads? I'm looking at high yield bond spreads around 500 basis points, 5 percentage points, and say typically during a recession or heading into one, you see 700 or 800 basis points in terms of credit spreads. This time is no different. How do you push back against that?
So I think that the big pushback is first, all-in yields are a lot more attractive now than they have been for, the past decade plus. We also have a fundamentally different high-yield market. We have more double Bs. We have more fallen angels that are now rising star contenders again. We also have a much better tranche of kind of liability management that has come through where maturities have been really pushed out. And also we have a leveraged loan market that's absorbed a lot of the more kind of stressed or highly leveraged capital structures that have gone to LBOs. So when you look at the high yield bond market, we can expect to see continued rates volatility, some spread volatility, but from a fundamental perspective, it is a much cleaner market than it has been historically.
Hey, Winnie, it's wonderful to hear your thoughts, as always. Winnie Caesar there of Credit Sites. Timed this perfectly, just perfectly. After January becoming cautious, then literally waiting for this to play out in the way it has done. Obviously didn't see it playing out precisely this way, but thought things had got too tight, and now sees things in a more constructive light.
If you liked it before the sell-off, why not
really
like it
now.
afterwards?
I totally get
Right, and so that's, one theory out there. However, as we've been talking about all morning, have the facts changed? And at what point do you have suddenly different parameters? And how do you get your head around what those would be?
USIG. There was a lot that was IG, which is now junk, right?
But that's my point, right? So all of a sudden, the downgrade risk becomes more tangible, at least in certain sectors of the economy.
Do you know what Danny Blanchflower thinks about the whole situation?
Cut rates to zero.
Danny's going to join us shortly. He's got things to say. So we want to give him the opportunity to say those things.
Absolutely.
Danny on the Bank of England. The Bank of England rate decision is about, let's call it 18 minutes away from the BOE. We're looking for a rate hike from Governor Bailey.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Worries over inflation trumped the recent banking turmoil as Fed Chair Jerome Powell rejected the idea of rate cuts and said that more tightening could be ahead. Wednesday's quarter-point rate hike comes less than 2 weeks after the second biggest bank failure in U.S. history. The Swiss National Bank raised its interest rate by 50 basis points and indicated that there's more to come. The SNB signaled that inflation outweighs any concerns after the market reaction to the downfall of Credit Suisse. Meanwhile, SNB Chairman Thomas Jordan says that Swiss banks are not exposed to U.S. bank failures. Citigroup CEO Jane Fraser says the string of bank failures has been isolated and that the biggest U.S. banks are well capitalized. Still, there's concern about smaller banks. Fraser spoke with David Rubenstein at an Economic Club of Washington event.
There could well be some smaller institutions that have similar issues in terms of they've been caught without managing the balance sheets as ably as others have done. And it's quite likely there may be a few of them. We certainly hope there'll be fewer rather than more, but again, it should be manageable.
You can watch the entire interview with Citigroup's Jane Fraser March 29th on The David Rubenstein Show, peer-to-peer conversations at 9 p.m. New York time. That's right here on Bloomberg TV. And there's a late twist to the sale of world-famous football club Manchester United. Bloomberg's learned that bidders have been granted extra time to come up with new offers. A Qatari consortium has already raised its offer above its initial $5.5 billion bid. British billionaire Jim Ratcliffe's first bid was below that, but he's also expected to increase his offer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We need to raise rates higher. We will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is.
Chairman Powell of the Federal Reserve. A lot of people think he did a decent job in yesterday's news conference. Stocks were lower, but not because of the Fed chairman, because of the Treasury Secretary. In a hearing at the same time, we'll get into that scheduling another time, at the same time saying that all deposits being guaranteed and insured wasn't even part of a discussion, a conversation.
He can't win, really, can he?
No, he
came
can't.
out and he did a great job by all accounts to basically be as dry as possible and not say anything new and not go off script. And then Janet Yellen goes, yeah, about that whole deposit thing, whatever you thought, it's not really the
He was never going to win.
Yeah.
We said it going into it.
He wasn't going to win.
Like there was no winning. There's no good decision. After yesterday, after the last few weeks. I'm sure Danny shares that view. Danny Blanchflower joins us now, the Dartmouth professor and former member of the Bank of England Monetary Policy Committee. Danny, the Bank of England, inflation year over year, double digits, people looking for a rate hike. Do you think that's the wrong move today?
Well, I do, as you might imagine.
I guess.
Obviously, there was some news yesterday, which was inflation rose more than folks think, but that's gone, that's passed. We're supposed to be focusing on what's coming. There's a major credit crunch, and the reality is that the Bank of England, in its forecasts, is forecasting no growth whatsoever for 3 years, inflation below the target, and we've just had a huge fiscal tightening. So basically, I assume they're going to raise. Everyone thinks they will. And what we're going to sit and watch here is disaster coming. Feels like 2008 all over again. Who's holding what bad stuff? Presumably in the UK, with the mortgage markets now in disarray, we're going to start to see banks holding bad mortgages, if you like, that people can't afford to pay. So I think this is the peak. This is a huge mistake. I would have been voting for big rate cuts. And what you'll see in the United States and the UK is disastrous data will show, and central banks will then move into panic mode, as the markets are pricing in already.
Danny, 25 is the wrong move. So let's talk about the Federal Reserve. Was that the wrong move yesterday?
Well, I think so too. I mean, we're seeing inflation now clearly has peaked. I mean, the question is, to what extent is this credit crunch a big deal? I mean, our pal Torsten Slot thinks that it's the equivalent of about 150 basis points of tightening. That's probably true. So this is a new set of tightening over where we were. The Fed has actually been entirely guessing. There is no economics to base their claims that this would be a soft landing. So you keep going and you keep going, but outcomes come about 18 months later. So the question is, what is there out there that we don't know? And you reported so well on Credit Suisse and the $9 billion that UBS had to receive to kind of make up for what's hidden under the hood that we didn't know. So at these times, you should be cautious as to what's coming on the downside. It's hard. I think the only question is, how bad is it going to be? So this looks like a wing and a prayer. We're going to carry on raising rates. Well, let's wait for some data to come. And my assumption is that it will start to come. I mean, the markets think it's going to come. I mean, Powell says, maybe we'll raise rates, but look at the Fed Watch tool. CME's Fed Watch tool says markets are pricing in 3 cuts by the end of the year. So why would you raise when the markets think you're going to cut? So we're in confusion. We're absolutely in confusion. And it really feels like 2008. In the UK, we rescued Northern Rock, thought that would solve everything. What happened was Bradford and Bingley, Alliance and Leicester failed, RBS failed, all about 6 to 9 months later. So watch this space. This was an error. Shouldn't have done it. There is no economic basis for anything that they're doing. And the real economy is what's going to matter. And wage growth is a big deal. That's not picked up in the way that they thought. Well, but really, the real economy is
Danny,
what we're going to do.
I have to cut in here because a lot of people are listening to what you're saying and saying, really, like 2008, banks aren't as leveraged at all. What you're dealing with is a liquidity crunch, not a credit crunch, at least not yet. And you're talking about assets that are backed by sound loans, not necessarily mortgage debt that was taken out by somebody with no income and who put nothing down. So this is a very different kind of scenario than it was in 2008. How do you push back against that and say that this is comparable?
Every credit crisis and every housing boom, for example, the standard thing that everybody says is this time's different for a variety of reasons. This time is different. It simply can't happen again. I mean, it's not just about that, Lisa. I think it's about confidence, remember. It's about confidence that the banks are whole. It's about confidence that my deposits are safe. And Janet Yellen, I think, made a huge error yesterday. I mean, her error was actually answering the question. So now we think, you have $1 million in some regional bank, what should you do? Well, obviously, you should pull that money out. If it's not guaranteed, then you should pull it out and take it to Bank of America. So that looks like an error, but it's about confidence, Lisa. And each time in the history of crises, everyone says this time is different. And I think the other thing is that, I mean, as I say, you guys have reported on it. What did UBS see under that hood that we don't know about? So I think that's a great deal of it. I mean, remember, as I say, in 2008, who would have thought in August 2008 that RBS would fail 2 months later? I think it's these kinds of surprises.
Let's put the
that
banking...
could be wrong, of course, but I think you have to be mindful that this is a credit crunch.
But let's put the banking crisis aside for 1 second, the known unknowns, the unknowns, whatever you want to call them, and just take a look at what the data was showing before this particular meeting, this sort of perhaps backward-looking, but hotter than expected inflation data that was persisting in the U.S. as well as in the UK and other European nations. From your perspective, have you been surprised by how sticky inflation has been, how long it has taken to show signs of coming down? And does that get you concerned at all about where we're heading in terms of Fed policy being used as a tool for financial stability and fighting inflation.
To some extent, I've been surprised, obviously, because there are shocks. In the UK context, there's shocks imposed by Brexit. But again, go to August 2008. What you said was essentially what people said then in August 2008. Inflation was 5.5%. Within 9 months, it had gone to deflation. And what we're seeing in the United States is those base effects are dropping out. Certainly, if you look at the unseasonally adjusted inflation numbers, they're really very, very low. I mean, a lot of actually what you're seeing is about this weird technical thing about the seasonal adjusting. So really what we're talking about is inflation's high because of the way they've seasonally adjusted using new methods. So I think the answer is that look at the wages. Wages have not picked up in the way that people thought. Wage growth has been relatively benign. I mean, it's hard to read the data, Lisa. I mean, it's as if people think we have a nice playbook. We have never seen anything like this other than the Great Recession. Every piece of data since 1945 to today is utterly irrelevant. We have to look at other crises, and what you'll see is then suddenly inflation plummets. So I think that's what's coming.
Danny, I've got to squeeze this in, just 60 seconds left. If they came out and offered blanket deposit insurance, would your view change?
Probably would, actually. I mean, I think in a sense the answer then, John, is that wouldn't the Bank of England and the Bank of Canada and the ECB have to do the same? But I do think that the blanket deposit insurance would really be a help. Certainly think that.
Danny, thank you, sir, for catching up with us. Danny Blanchflower there of Dartmouth, going into the Bank of England decision 6 minutes away. Seems like that's a game changer. Even for someone like Danny, thinks that they should cut all the way back to, I don't know, 3, 2, whatever it might be. Danny can speak for himself. That if you come out with that deposit insurance, it could change everything, which is why I think it's quite difficult for the Fed to make the right call. They've only got the last 2 weeks to go on. Do they extrapolate that out through the rest of the year and start cutting interest rates? Who's going to do that?
Well, and we don't understand what the banking system will look like if they don't provide deposit insurance. There doesn't seem to be the political will to do that, and that would really have to come from Congress, and that's part of the problem that I think Jenny Yellen was facing off with yesterday. The issue that I think Danny is raising, and rightly so, is that you're not solving the problem by just saying we're going to swoop in and save deposits or insure them in a systemic crisis. How do you know which banks are systemic? How do you know which banks are going to rise to the occasion for some sort of rescue? Can you count on that in the same kind of way as you can count on one of the biggest banks that will hold your deposits?
The Fed chair has given you the playbook now for monetary policy. Believes the situation is a substitute for rate hikes. To what extent, we don't know. The longer it continues, the worse it gets, the less they'll have to do, and the more we'll start thinking about them moving the other way and cutting interest rates.
Which is the reason why you see that priced into the market right now.
The question is, can you make that call today as a Fed chair?
I don't think you can. I don't think you can.
We can say in a couple of months' time, what an idiot for hiking interest rates.
We would. Either way, he will be somehow.
It's tough.
The whipping post here.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Teen phenom Coco Gauff takes the court Thursday in her opener in the Sunshine State when she faces Canada's Rebecca Marino. Top-ranked American Jessica Pegula also in action at the Hard Rock Stadium. She goes up against Catherine Seeboff in round 1. And don't forget, you can watch all the action from Florida exclusively live on Tennis Channel.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
We're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
And we've got another rate hike, this time from the Bank of England, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back with us on Monday. As you all know by now, he's been away all week, missing the action. Cable right now, sterling stronger by 0.5%. The Bank of England raising interest rates from 4% to 4.25, up 25 basis points over on Threadneedle Street. And Lisa, just like the Federal Reserve and the ECB before them over the last week, you have to take a stance on monetary policy and then explain your thoughts about financial stability at the same time.
And basically, they said that they're in conversations with policymakers and do see stability in the banking system, which is pretty much as you would expect. But that really is one of the themes. What they did say was not only are they going to raise rates to 4.25%, but signs of inflation persistence would require more hikes. So not exactly taking hikes off the table going forward. It was a 7-2 decision. So I'm curious about those two dissents and what exactly they were looking for. And they were also looking forward to ongoing scrutiny of any more potential stress in the banking system, but calling it resilient, that same word that you hear from central bank to central bank.
You do, and there's a very clear distinction between what's developing here in the United States compared to, say, the UK and Europe. There is a belief here in the United States that the financial instability of the last couple of weeks is going to lead to tighter financial conditions, tighter lending standards, and a belief on the committee at the Federal Reserve that that is a substitute for rate hikes, even up against inflation that's too high. In the UK and Europe, seemingly, Lisa, they haven't seen enough evidence in the UK or in the Eurozone to make the same argument.
Not only that, but they're actually increasing some of the projections for the economy and economic growth. So exactly that. It doesn't seem like this is the same kind of deterrent to rate hikes going forward in Europe as it is in the U.S., which raises this question of, are we seeing that ongoing divergence between U.S. and European policies at a time where there is a difference in terms of where the disinflationary process is?
4%, the previous rate. It's now 4.25 over at the Bank of England. Sterling a little bit stronger, 123. the pound against the US dollar, 123.08 right now. Over at the Bank of England, outside the central bank, is Bloomberg's Lizzie Burden. Lizzie, your thoughts on this one?
Well, it's the smallest hike since June, but it was what we were expecting, John. It takes the key rate to 4.25%, the highest level since 2008. That upside inflation surprise yesterday really nailed this on. Remember, the bank has had this data, we think, since Monday. But as you say, it follows the ECB, the Fed and the SNB. You might say that they're all prioritising the fight against inflation over financial stability. But really, the bank's always said that it's not bothered about short-term volatility. It's focused on the long game. And also, remember, a stable inflation environment contributes to financial stability. There's no press conference later, but it's interesting the vote split 7-2. We had expected a 6-3 split with John Cunliffe expected to join the Doves. He hasn't. It's just Silvana Tenreiro and Swati Dhingra. They've both expressed their concerns about previous jumbo hikes having yet to fully take hold because of the lag in monetary policy. Dhingra as well has said that she thinks domestically driven inflation is being overestimated. She's a trade expert. But looking at the future path for rates, they'd already removed the language about acting forcefully and downgraded it to the need for further tightening if necessary. And in terms of the inflation outlook, the bank says that inflation's now likely to fall sharply over the rest of the year, that the second quarter inflation forecast will be lower than was seen in February. So that's good news for the Prime Minister Rishi Sunak. Of course, he's made cutting inflation his #1 priority.
So can we categorize this as a dovish hike, or is this basically a hike with a lot of uncertainty and question marks around it, and perhaps a bit more confidence in the financial system in the UK than in the US?
Well, I would read the fact that John Cunliffe hasn't joined the dissenters as showing his confidence in the financial system. Remember, he's in charge of financial stability. They have added guidance saying that they're closely monitoring credit conditions. So yes, there is an element of uncertainty, but over recent days, the Bank of England and the UK Treasury have been at pains to stress that they're confident in the financial system. So it's as expected, but they are showing their confidence in what we have here.
Lizzie, wonderful coverage throughout the whole of this morning. Lizzie Burden there. Over on Threadneedle Street, or rather just on the other side in front of the Bank of England there. Lisa, your thoughts on this one? Clearly, across the ECB, the Federal Reserve and the Bank of England, there is one key similarity. They're all worried about the signal they send around the monetary policy decision. You heard it there in that report from Lizzie. There was maybe a little bit of reluctance to join some of the doves because you don't want to project that you're worried about the financial system at the same time as saying it's robust.
This just casts a muddy pall over everything that is already muddy. I mean, how do you look at inflation with any kind of clear lens if you're also worried about signaling at a time of all of this concern around a banking system that a lot of people are saying is resilient? Everyone has to say that. And at the same time, you are seeing concerns that percolate from one to another. It's like whack-a-mole. Who's going to see some concern next?
Joining us now is Alessio De Longa, Senior Portfolio Manager at Invesco. Alessio, you started the year constructive. You came into March less constructive. Alessio, talk to me about the change there, given what we've seen transpire in the last couple of weeks.
Lisa, John, thank you for having me. Yes, at the beginning of the year, we had a very constructive view, which panned out a little too fast and too far. So when we entered in March, many of our indicators started signaling a little bit of an extended price action and sentiment that was beginning to roll over as a result of renewed positive inflation surprises, bear steepening in yield curves, and the repricing of additional policy hikes. That led us to, from a cyclical perspective, to reposition again for a defensive asset allocation posture. What happened with the banking developments over the last couple of weeks has accelerated that path, has validated that path, but it's important to make a distinction. We have been able over the last couple of weeks to rule out, thanks to the policy actions and the developments in Switzerland, to rule out a systemic accident in the banking sector. With that being said, the tensions in the credit markets have increased. From a cyclical perspective, wider credit spreads, wider lending, more restrictive lending standards, and lower credit growth are necessary conditions to have monetary policy tighten in the future and bring inflation down.
Alessio, there seems to be a policy divergence driven by the fact that the U.S. financial system, and I'm talking not about the big banks, but the regionals that are subject to some of this deposit flight, that the banking system does have a more pervasive issue that needs to get dealt with than some other nations, including the UK and including Europe more broadly, continental Europe. Do you agree with that? Can you trade on that? Is there something underpinning that in terms of perhaps ongoing rate hikes in Europe and the end of them in the U.S.?
I think the cyclical divergence is there in growth and in monetary policy. On the margin, from this point on, I think with the Federal Reserve, we're looking at marginal increases, let's say another 25 basis points hike in May. But the ECB and potentially the Bank of England, I think, have more to go, at least another 50, if not more. That cyclical divergence can be expressed through multiple venues. Again, I'm ruling out I wouldn't say that we can trade on the more structural systemic aspects of potential bank regulation. I think what we should focus on is trading on that cyclical divergence, trading on the cyclicality of the perception, which I think has returned. The last couple of weeks were more of a risk of a systemic shock that would have changed that dynamic. But I think now we are more comfortably back into the typical end of a tightening cycle pricing dynamics.
So when can you go back into European banks?
European banks are not for now, in my mind. We favor a bias away from value and away from cyclicals, of which banks are one, more into quality-oriented, lower volatility and growth-oriented sectors. So defensive sectors such as healthcare, consumer staples, and even technology, which screens now on quality characteristics. And we have seen that quality pan out as soon as rates began to rally again. Those sectors and styles with longer dated cash flows and more duration have outperformed. We think this is an environment for defensive sectors.
Alessio, just quickly, just to wrap it up, are you working on the assumption now the Fed is done?
Working on the assumption that one more hike and then we are done. So cyclical divergence in favor of European equities, in favor of the euro, and a global backdrop where a policy being done is not necessarily the recipe for a rally just yet. We need to see the impact on growth first.
Interesting. Alessio, thank you. Alessio, the longest there of Invesco. What'd you make of that?
I like the idea of divergence. I'm just trying to wrap my head around what that means. Because if you do talk about a growth divergence, then shouldn't you see some of the more cyclical areas of the European market doing better than over in the U.S.? And you're not really seeing that in the same kind of way. So I don't really understand how to sort of square this circle from an investing perspective. This is an incredibly confusing market, basically.
It's too soon to draw conclusions after the last couple of weeks. I'm just going to keep repeating Dan Iverson at PIMCO, which is usually the safe thing to do based on his record over the last several decades.
And then ask me what I think.
Which is, it's a multi-month process. It's a multi-month process. It's too soon to talk about the ripples out from this.
How long do I have to deal with this? With you just
for
repeating over and over again? It's a multi-month process.
For a few more months, basically.
You're not wrong, and neither is Dan Iverson. The problem is that people have to make calls and changes.
No, I know, and then people on programs like this have to come up with something new every single day. I get that.
I know, and you feel.
But sometimes just make it boring and say it how it is. It's been 2 weeks. It's been 2 weeks. We've had 2 weekends where bankers have had to sit there and listen to regulators as their banks have basically shut down. 2 weekends of that. We've got no idea what next weekend looks like or the weekend after that.
This is true. People are clinging to what they do know, which is it does change the scenario to some degree in terms of credit standards and the lending,
but, you know,
the willingness
it's the psychology in investing. And you know this, Lisa. They're clinging to what they want to happen and using what has happened just to plug into their view that already existed. You know, everyone was already, everyone was there at the start of the year. They're going to cut. The Fed's done. Recession's coming.
Okay.
Now they've got a new reason to make the same call.
Yeah, but this one's right.
Yeah, well, maybe. Maybe. It's like I said, Danny's the biggest dove anywhere.
Yeah.
You turn around to Danny and you say, would your view change if we got blanket deposit insurance?
Yes, it would.
His view would change. Now, how quickly could that happen? I don't know, but is it possible?
It's a great point.
Sure, it's possible still.
It's a great point.
Futures right now on the S&P. On the S&P 500, we look something like this, positive 0.4%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill today, the CEO of TikTok faces a number of lawmakers who want the video game app banned in the U.S. Republican chair of the House committee holding the hearing, Kathy McMorris Rogers, will tell Show 2 that its popularity exposes a vulnerability that could be exploited by China. TikTok says it has spent $1.5 billion to address data security concerns. In New York, the grand jury considering charges against Donald Trump reportedly is expected to reconvene today. That's according to ABC News. The case involves alleged hush money payments to porn star Stormy Daniels and whether the former president concealed the payments. He's denied any wrongdoing. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals which the U.S. has rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. Apple's launching an ambitious effort to raise its profile in Hollywood and attract subscribers to its streaming service. Bloomberg's learned Apple will spend $1 billion a year to produce movies that will be released in theaters. The list of potential releases includes films from directors Martin Scorsese and Ridley Scott. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The moment news breaks, no one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
They're happy to export something here that 150 million Americans are consuming 3 weeks a year, you know, on a platform that's run by the CCP that may serve their interests in hoovering up data from the American people. I think the American people have the imagination, if we chose to choose a different platform, and I think that's what we should do.
That was Senator Michael Bennet there of Colorado on Balance of Power. Just on Wednesday, talking about TikTok. The CEO of TikTok is looking to defend the company on Capitol Hill a little bit later today, saying in prepared remarks the following: TikTok has never shared or received a request to share US user data with the Chinese government, nor would TikTok honor such a request if one were ever made. So he's going to sit in front of these senators, Lisa, he's going to say exactly that, and what do you think the senators are going to say back to him? Do you think that is going to convince them when they turn around, or rather the House, the representatives of the House? Is that going to convince them?
Well, it can't convince them because the empirical data would highlight that the Chinese Communist Party doesn't exactly take, we're not going to honor your request very well. So that wouldn't necessarily go over in the same kind of way as perhaps they would wish. This is really the question that I have. To what extent is the questioning going to entirely rest on national security and how to ring fence the data, and how much is it going to really focus on some of the other, perhaps, side effects of social media? And the reason why I think that's important is because how much does it really target other social media companies as well versus just isolate TikTok from a national security perspective?
We'll come back to this story in just a moment. If you are just tuning in, about 18 minutes ago, the Bank of England hiked interest rates by 25 basis points, a 25 basis point rate hike after the ECB went 50 last week and the Fed went 25 just yesterday. But just run you through the price action briefly. The equity market futures still doing okay at 0.4% on the S&P 500. Sterling was rallying off the back of the decision. And in the bond market at the moment, your two-year yield is higher by 3 basis points to about 3.96. Still get some economic data, Lisa, in about 12 minutes' time. We've barely talked about it. And I do think the news conference yesterday has changed the way we will receive that incoming information and that economic data for the Federal Reserve, because the Federal Reserve has basically told you that what dictated the outlook, to some extent, wasn't just inflation, it was financial stability.
So when does the data start to matter again? The economic data I'm talking about. And this is something that we've been talking about for a while, that we got hotter than expected inflation numbers for a while. So that at what point do you come in and say, okay, now we are looking at that again, and now we are looking at the potential for a resurgence in inflation?
Let's get to Anne-Marie. She's over in Washington, D.C., our chief Washington correspondent. AMH, this Thursday, today, in front of the U.S. House Energy and Commerce Committee hearing, the CEO of TikTok will speak. What can he say today to allay some of these concerns?
So one thing that he's really going to want to highlight is this idea of this plan they have called Project Texas. It was a way to try to ring fence, isolate U.S. user data in the United States, use Oracle for this. But when you have reporting like I have last week that the U.S. government is telling ByteDance, you need to divest, sell these shares, or face a ban. Clearly, Project Texas was not sufficient by CFIUS in terms of protecting that user data, that they are now telling ByteDance that this is the option. You either need to sell or face a ban. So the CEO is going to try to do whatever he can to talk about this, what they call unprecedented action, how much money they spent on this, and how they really feel like this is secure, and also that he will likely mention that the Chinese Communist Party has never asked TikTok for any of this user data. The issue is most of these lawmakers are not going to buy it. It's become too long. This has been an issue for too many years, and they just don't see the reason why TikTok should be allowed in the United States, given the fact that it's owned by ByteDance, when even TikTok itself is not even allowed in China, and it's also banned in India.
Anne-Marie, to answer the question that John asked me earlier that I kind of punted on and basically gave a very messy response to, what is the next steps if Congress does sign off on some sort of bill? Is it just to shunt it over to President Biden and say, over to you, this is yours?
Well, so what would happen is it depends on which bill it is. There's 4 really standout TikTok bills that we are keeping our eye on. The one that has the White House backing is this one by Senators John Thune and Mark Warner. Now, this doesn't even mention TikTok in the bill. What it does do is it gives this broad support to the Commerce Department to really look into it. This was an executive order actually under the Trump administration, so it would basically mean that executive order stands. It would give the Commerce Department the needs that they can go through this, look to see if there's any national security issues with not just TikTok, but other companies coming from what they would call foreign adversaries. And then the Commerce Department would then make their suggestion. That would likely lead to a ban. But then again, what I said earlier is this could take months, right? We don't even have this bill on the floor yet. These are just ideas at the moment.
Anne-Marie, we're going to be following this throughout the morning. The hearings start at 10 a.m. I do want to pivot just slightly as we are talking about this issue, perhaps affecting a lot of teenagers. But the bigger issue for markets right now very much is deposit insurance. And I'm wondering what the latest is and what you expect to hear from Janet Yellen, whether there has to be some sort of cleanup act today, given some of the response in markets and the messiness of the communication, the divergence between her and Jay Powell.
Yeah, so yesterday everyone thought Federal Reserve Jay Powell was going to make all the news, but it was actually at a subcommittee for appropriations for the Treasury Secretary. First, we should give you some context. She was scheduled to go there to talk about the 2024 fiscal budget. You're going to see a number of Biden cabinet members up on the Hill this week. Today will be Pete Buttigieg talking about the transportation budget. We also had Secretary Blinken yesterday talking about the State Department's budget. But obviously, given what we've seen of the past 2 weeks in the banking sector, she was asked about this. Our reporting was that U.S. officials were temporarily looking at ways to expand the FDIC insurance. This is something that mid-sized banks were asking for. The question asked to the Treasury Secretary was about if Congress would have to have approval. So she was saying, and I think it's the use of the word blanket that is very key here. She's saying that we are not looking at a blanket use of this. So potentially our reporting about more temporary, an emergency response, she made clear in her statement they're not looking at a blanket case for this. That would likely need congressional approval. But she also made the case in this answer that the reason why they lifted that FDIC insurance cap is because they saw a risk of contagion. So she said if we see any sort of systemic risk that there could be a bigger run on banks, that's when we would have to go in and use this emergency power.
AMH, great work, as always. And a key distinction, I think this key distinction is really important. Secretary Yellen is in a really difficult spot right now in these hearings. It's a circle you can't square. It's just really, really hard to do. You can sit there and say, if a bank fails and it has the threat, poses the risk of contagion, we can use the systemic risk exception to make all depositors whole. That makes sense. She keeps repeating it. She can't sit there and say, yeah, we're about to do a blanket guarantee of deposits. She can't do that yet. She can't say it.
She doesn't have the authority to do that because that really does lie with Congress, and this is the problem. And at the same time, how does she give confidence to a system? I do wonder if people are going to start saying, well, how about more transparency? How about a greater sense of which banks are raising red flags to you in terms of the duration mismatch or how much they have to fulfill any potential deposit withdrawals or concentration in particular industries, right? I mean, what if they did something like that where they just made it clear to everybody so that they had a sense?
Lisa, I've got to run, and they've got a really important conversation coming up in the next hour. Kathy Jones of Charles Schwab, Sam Linton-Brown of BNP Paribas, Robert Tipp of PGIM Fixed Income, David Bianco of DWS as well. That's the lineup, Lisa, going into the opening bell.
Can't wait to hear some of the conversations and parsing through what to watch going forward. We have been talking about TikTok all morning. That is going to be dominating Capitol Hill. Mark Warner joining us, the senator from Virginia, who is leading up some of those hearings in front of the House, in front of the Senate committee, as we do expect a no-win situation right now for the chief executive officer of TikTok. Can you give us a sense of what you're hoping to get out of these hearings, Senator Warner?
Well, unfortunately, I'm not going to be in the hearing. It's actually a hearing today in the House. But I've had concerns for some time that the United States has not had any kind of rational policy about how we deal with foreign technologies from countries like China and Russia that pose a national security threat. A few years back, it was the Russian software company Kaspersky. Back in 2019, we went through a long debate about Huawei. Now we're talking about TikTok. So I put a bipartisan bill together that's been endorsed by the administration. I got 10 Democrats, 10 Republicans that said we ought to give the Secretary of Commerce the authorities and tools that could, if there is a national security threat, allow her to take actions up to and including divestiture and including banning. And why TikTok? Two reasons. One, TikTok is extraordinarily popular. Let me acknowledge that. 150 million Americans. Some of the data I've seen on average about 90 minutes a day. What TikTok's genius is it learns from you every time you're on. So it's getting and collecting data that is individually specific. At the end of the day, no matter what the TikTok CEO says, Chinese law made clear in 2017 that ByteDance, Chinese company that owns TikTok, at any point, the Chinese government can require that data be turned over to the government. I think that has the ability to harvest data that could be used. It's already been demonstrated to be used to spy on journalists. It could be used to target certain people in the Chinese diaspora. It can be, frankly, used to ultimately target some of our kids who are on that site on such a regular basis. So the data collection is number one. The number two part is this is a huge potential propaganda tool Should President Xi decide that he wants to go ahead and take on an invasion of China, or I'm sorry, invasion of Taiwan, TikTok could be that site that is saying to literally hundreds of millions of folks all around the world, 150 million Americans, hey, that's not so bad in terms of